I'm Shauna Smith alongside Brad Smith. It's ahead of the opening bell on the Wall Street. The gains coming on the heels of a weaker than expected jobs report, sparking investor hopes that the labor market might be weakening enough for the Fed to keep a rate cut on the table sooner rather than later.
And we've got a slew of Fed speak on tap. Richmond and New York Fed Presidents Tom Barkin and John Williams, respectively, going to be speaking. And then Neil Kashkari, Susan Collins, Mary Daly, Austin Goolsbee, and more spread throughout the week. So let's get to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Madison Mills, and Brian Sazi have more.
We are looking at green across the screen. Stock futures rising as jobs data boosts optimism around rate cuts. Wall Street also awaiting another big week of corporate earnings. According FactSet, 80% of S&P 5 companies have reported results, with 77% beating profit expectations. This week, we're tracking results from Palantir, Disney, Reddit, Airbnb, and Warner Brothers Discovery, among others.
And Berkshire Hathaway's annual shareholder meeting was this weekend, the first without the company's vice chairman, Charlie Munger, who died late last year at the age of 99. CEO Warren Buffett speaking out on a range of topics, from Berkshire paring its holdings in Apple to selling all shares of Paramount. Then speaking about the AI boom as well, which Buffett compared to the discovery of the nuclear bomb. Buffett also answering questions around succession, saying he expects Vice Chair Greg Abel to make investing decisions after his own eventual death.
And the Milken Conference kicking off in California. Lots to talk about, so little time. Yahoo Finance on the ground Monday and Tuesday all day. A couple things I'm watching here. The impact of higher for longer interest rates, very important after the favorable market reaction to that jobs report last week. Does the crowd here denounce a second potential Trump presidency? And last but not least, Elon Musk will be speaking later on today. What does he say about AI and the coming vote on his pay package?
Well, good morning, everyone. Let's chat Buffett's big weekend. Shauna, you were on the ground in Omaha. We got to get some of your key takeaways here.
Yeah, Brad, it's a remarkable weekend. It's so much fun. You were able to speak with so many well-known investors, very influential investors here over the last several days. Also, I was able to speak with so many people who have been following Buffett for such a long time and very familiar with past investments and exactly what he was saying over the weekend, maybe what that could signal here going forward. So we have three takeaways, at least my takeaways are from this weekend. First, we got to start with Apple, because that was one of the big headlines coming out of the report that was released ahead of the meeting on Saturday morning. Berkshire reducing its stake in Apple by about 13%. I think initially many shareholders, many on the street who were watching this, were wondering whether or not his stance on Apple changed. And he was very clear in the fact that he remains extremely confident in Apple. Actually, Tim Cook, the CEO of Apple, was in the audience on Saturday, so that was very cool. But he remained very upbeat on Apple, saying he thinks that Apple is very, very likely, outside of something catastrophic happening, that Apple will remain its top holding within its portfolio by the end of the year. So really signaling the confidence here in Apple. Then AI. That was my other takeaway, and kind of some of the commentary, cautious commentary that we heard from Buffett on AI over the weekend. He was extremely cautious, likening it to when the development of nuclear weapons, saying that we let the genie out of the bottle with the development of nuclear weapons. AI is somewhat similar, and it's partway out of the bottle. And he talked about an experience that he had with his own image and his own voice, saying that it would actually be tough for his wife or for his kids to even realize that that was a deep fake. So just talking about some of the downside risk, which we have talked about many times here at Yahoo Finance, talking about how exactly that relates to AI. And then real quick, Paramount was also a key takeaway for me, because the company, or Berkshire, no longer having a stake in Paramount, Buffett taking 100% of that quote-unquote blame for it, saying it was 100% my decision, we sold it all, and we lost quite a bit of money. Beyond that, he didn't really have much to say about Paramount, to no surprise. But again, Apple, AI, Paramount were the three big takeaways for me.
Yeah, he was kind of jumping the questions, anticipating what was going to come forward, both in interview and also from the audience, and crowdsourced questions there from the investors. And you mentioned Apple here, just to come back to that, because we're tracking shares of Apple here pre-market, and of course a lot lingering on what Buffett says about Apple continuously. And he still said that we're going to have Apple as our largest investment, as you were mentioning a moment ago. But it's interesting to also see where an investor such as Warren Buffett and the broader Berkshire Hathaway community are looking at this opportunity as a building of cash position type of opportunity too. Said that I think when people look at the alternative of what's available, the equity markets, and I look at the composition of what's going on in the world, we find the cash position and building that cash position quite attractive right now. So that was something that was interesting to take away too.
Yeah, and further to that point, he said that I don't see anyone sitting at this table has any idea how to use it effectively, and therefore we don't use it. When he's talking about the fact that once again their cash pile is at a record high, the fact that they did take some profit here from Apple during the quarter. And then I also asked Gregory Warren over at Morningstar, who covers Berkshire, just his thoughts on the fact that they did reduce their stake within Apple. And he was saying that it actually makes sense and it doesn't hurt to take a little off the top here at this point, saying that this does not concern them at all because Apple is such a large position within their portfolio, specifically at the end of the year. So anything to lessen that exposure is good from a diversification perspective there. So again, alleviating some of those fears out there initially. Fears and maybe concerns or questions is a better way to put it about whether or not Buffett's stance on Apple has changed. But at least for now, it doesn't seem to have changed at all. All right, another big earnings week this week with a shift in focus from tech to the consumer. A slew of names reporting, giving investors a better look at how consumers are spending. To break it all down, the biggest risks right now to the market, we want to bring in Samir Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Samir, it's great to have you here. So first, let's just take a step back and take a look at where we are trading today with the Dow, the S&P, and the Nasdaq not too far from those record highs. What do you make of today's valuation and whether or not maybe we could see some profit taking at this point?
Yeah, I mean, that's a great point. I mean, we would say you're probably a little bit above fair value. Our year-end target is 5,100 to 5,300 for the S&P. So, again, we're kind of right smack dab in the middle of it, which tells me that there's maybe a little bit of asymmetric risk to the downside, just given some of the events that are out there, right? You could still have, tensions kind of flare up in the Middle East. You could still have the Fed disappoint and not cut at all. You could have some combination of economic data that, kind of rolls over without inflation kind of cooling off. So I think there's just a lot of different risks that, if you can take some chips off the table at the all-time highs, it's a pretty good idea.
I mean, just reading through some of the review and statistics coming out of this earnings season, Samir, I was looking at some of the FactSet data, and it's really showing that companies and the market right now is rewarding positive earnings surprises less than average here, and that also means that they could be punishing some of those negative earnings surprises a little bit more, typically seeing an average price decrease for companies who report negative earnings surprises for the first quarter of 2024 with a price decrease of about 3.3% 2 days before the earnings release through 2 days after the release. And so that's larger than the 5-year average. I mean, what does that all tell you about what investors are looking for in some of the reports coming through over this season and the forecast even into the rest of the year?
I think what they're looking for is a pullback, right? I think what they notice is a market that's only gone in one direction. I think it makes them nervous because I think it probably means that a lot of players have forgotten what volatility looks like. And it tells me that, with all the events that are out there, like the elections, like some of the currency volatility that we've seen recently, it tells me that a lot of people would probably head for the exits all at once, leading to episodic volatility. And so I think there's a lot of investors saying, you know what? This may be near term, as good as it gets. And so unless earnings are just blowout, or unless the stock has pulled back before those earnings, which leaves some room for upside surprises, I think they're just saying, look, I'll just kind of take my money. You just mentioned Buffett and his largest holding, right? Again, he's not bearish on it, but he's taking some profits. And again, there's nothing wrong with that.
So then where does that leave just the investment opportunity that you're seeing right now? When you talk about the outperformance or recent outperformance that we've seen in a handful of tech names, when you talk about the outperformance in communication services, is it time maybe to rotate out of some of those top performing names?
We haven't liked those for a while. Now we are neutral, so those are full weightings. But what we came into the year with was energy, materials, industrials, and healthcare. And 3 of those 4 have done really well, especially recently with kind of inflation expectations having ticked back up. From a timing standpoint, I think energy makes a lot of sense. You've seen oil kind of dip back down to below 80. And I think healthcare makes a lot of sense. There's a lot of kind of meta trends that are going on there that are maybe underappreciated and then otherwise, kind of sluggish market.
And so additionally here, as we're thinking about what the theme of this earnings season will have to really kind of signal about the rest of this year and outlasting some of the larger catalysts that could actually push markets to the downside, i.e. rate cuts and not getting as many as the market anticipated or none, as we've increasingly discussed, and then the election as well here. Where does that leave some of the company executives in this near term and the spending decisions that many of them are still making, especially on the generative AI front right now?
So you're seeing extreme amounts of caution, especially on the labor side. And I think elsewhere, you're also seeing quite a drive for efficiency. So what that tells me is corporations are getting ready for possibly two-way risk. Again, you do have elections coming up. You do have, rates that have been high now for a couple of years, which are starting to weigh on the consumer. A lot of the consumer-oriented companies have mentioned that caution on the part of consumers. So I think companies are getting ready for, again, just kind of that two-way risk. I think, unfortunately, investors aren't quite yet ready for it.
Samir Samana, who is the Wells Fargo Investment Institute's Senior Global Market Strategist. Thanks so much for kicking off the week with us.
Thank you.
Well, we're also kicking off our coverage of the Milken Institute's Global Conference today with discussions on everything from AI to geopolitics. Our very own executive editor, Brian Sazi, and Akiko Fujita standing by on the ground in Los Angeles. Saz, what are you hearing so far here?
Brad, well, the room is filling up here at the Beverly Hilton in California. And Akiko, good to see you, of course. And for me, just continuing a lot of the great reporting that Shauna did at Berkshire, and of course what Warren Buffett said about AI, I can't wait till we talk to IBM CEO Arvind Krishna. I mean, here's a company that some would argue was behind in the AI race, is now starting to catch up. Pretty good earnings report a week ago. I am fascinated by what they say on how their business will power the future of AI after Warren Buffett really struck a cautious tone on the impact of AI on society.
Yeah, AI, a general theme here among many. It is about AI business, as you point out, with companies like IBM. It is about the ethics, the regulation. What's interesting about Milken to me, as always, is just how global the reach is. And so it's not just about the U.S. companies. We've been talking about this. You've got the sovereign wealth funds from places like Saudi Arabia, as well as the UAE, who are huge, huge investors in some of these AI companies, building potentially some of those AI chips as well. So that's going to be an interesting conversation here on the ground.
That was a good theme called out by you, Kiko. And of course, Elon Musk is speaking, 5 p.m. tonight. The stock has been on fire since the company reported earnings a couple weeks ago as they teased a smaller electric vehicle. I would love to hear Elon make the case on why they think, or he thinks, this is an AI company, not a car company.
Yeah, I mean, there's going to be a lot of questions that investors are going to be looking for in this very conversation. It is about why they're doubling down on robo-taxis. Is that cheaper alternative in terms of a car? What is that going to look like?
Are you going to take one of these, Kiko? Are you going to get in that robo-taxi?
Well, I don't know about the robo-taxi, but here's what's interesting. The conversation about whether Tesla is going for a cheaper model coming at a conference where you've got Stella Lee from BYD, who is offering the cheapest price point globally. You've also got Volkswagen here. So there's going to be some really interesting conversations in terms of the transition overall, particularly in the clean energy space.
It's just interesting to talk about electric vehicles, Akiko, with all the Lamborghinis and Ferraris floating around here. It's just
welcome to EV land.
Welcome to EV land, Brad. I know you're waiting for your Ferrari. I think it's on order, right?
Yeah, I got the one that Hasbro or Mattel is making. So that one is on back order right now. What interviews, though? I mean, there's going to be a lot of interviews that we can look forward to as well out there here.
Yeah, well, we're about moments away from starting our coverage here with Mark Rowe and Apollo, the CEO of Apollo Global Management. Of course, Apollo is the parent company of Yahoo. I'm very excited about the interview. A lot of good things that Apollo is doing in retirement services, so we'll hear more from him. You mentioned IBM CEO Arvind Krishna, and Akiko, I know you have a bunch of big ones as well.
Yeah, we're going to be speaking with Kevin Rudd, who's the former Prime Minister of Australia, also now the U.S. or ambassador, Australian ambassador to the U.S. He's always got really good insight on what's happening in China specifically. So I'm really interested in that conversation. We'll also be speaking to Kevin Hassett, the former chair of...
and was floated as potential, Fed chair? I mean, this guy, he's having a moment.
Yeah, so a lot of conversations that are going to be happening on the ground here. Of course, you already hit on some of the themes here, Brian. It is about the questions around higher for longer. What does it mean for businesses? The election's certainly going to be a big one. It's not just about the politics of it. What does it mean for something like the Fed? What does it mean for policy? As we pointed out, a global conference here on the ground. So there's going to be a lot of people looking for some cues on what a potential second Trump presidency could be.
Yeah, I'm really curious, Brad and Shauna, too, how a lot of these leaders are planning for potential Trump presidency. So far, you're not hearing much of that being talked about on these earnings calls, but this is really the last big conference before the election. So this is the time for leaders to speak out and say whatever they want to say.
I look forward to getting their insight and also for your conversations with all those great guests that we have lined up over the next couple of days. Akiko and Saj, you guys are going to be busy. We'll let you go. Thanks so much. All right, well, we are just getting started here on the Morning Brief. Spirit Airlines posting a wider than expected loss in the first quarter as its CEO warns that the current environment, quote, remains challenging. We will dig into that report next. Plus, we'll continue our live coverage from Milken's Global Conference. Our executive editor, Brian Sazi, he is going to be speaking with Apollo Global Management CEO Mark Rowan. That's at 9:40 a.m. Eastern time this morning. You won't want to miss that. Plus, in our new show, Catalyst, we will break down top takeaways from Berkshire's annual shareholder meeting. All this and more. You're watching Yahoo Finance. Spirit Airlines shares falling this morning after posting a wider than expected loss here for the first quarter. The airline CEO saying that the current environment, quote, remains challenging. Now, these results coming after Spirit announced the termination of its merger agreement with JetBlue back in March. We know that this is a result of the fact that it was not approved there, and more pressure there. Questions about what exactly the future of Spirit looks like now that that deal with JetBlue was not approved. The fact that they did abandon all plans for that merger, and exactly their ability here to compete or even remain viable at this point. I know, Brad, you're closely covering this space, but lots of questions just about how exactly Spirit can and will turn some of their momentum around.
I didn't mean to laugh, but the quarter was not good. Total operating revenues down 6.2% year over year. Total revenue per available seat mile, that TRASM figure that every airline company talks about, down 8% here. And oh yeah, here's the kicker. When you think about the consumer environment right now and what the demand environment right now, especially at certain fare prices, looks like, remember, this is in the ultra low cost carrier ecosystem here for Spirit Airlines, really rivaled only by JetBlue and Frontier at this juncture. Their fare revenue per segment was down 16% year over year, $48.08 is that figure that it came in at. And so if that tells you anything about what they're ultimately seeing right now and where consumers are not only pushing back on prices, but also looking for any type of deals that they can get. And if this is true for Spirit, they could also be saying, okay, where can I get around some of the nickel and diming that certain ultra low cost carriers have been known to do? Spirit has been perhaps one of the kind of logos next to the definition of that in Merriam-Webster's at this juncture. All things considered, the company is saying over the last several months the team has been engaged on working on this first phase of a new standalone business plan. Comes back to your point, Shauna, they're already planning to not see this merger go through, and so now they're trying to figure out what levers they can pull. That also means furloughing pilots. They'd already announced that going into this print, and then additionally, some of the mechanisms that they're going to have to enact on the fleet that they operate as well on the aircraft side, delaying some of the delivery or taking delivery of those aircraft.
Yeah, certainly a very, very weak quarter, and also some of the commentary within this release. We're getting more here on the call, but some of the commentary within this release pointed to a pretty bleak future, at least here in the short term for Spirit. All right, Robinhood shares are a trending ticker here on Yahoo Finance this morning, falling after disclosing that it received a Wells notice from the SEC now alleging security violations. And the focus of the Wells notice is the company's U.S.-based crypto business. Now, Robinhood saying in response that it's disappointed that the agency decided to issue a Wells notice. Not a huge surprise there, but exactly what this means, how the potential action, it may involve a civil injunctive action, a public administrative proceeding here, and or a cease and desist proceeding. So Robinhood getting the SEC notice on recommendation of enforcement action against a crypto unit, and that's clearly weighing on shares here ahead of the opening bell today.
Yeah, we've reached out to Robinhood for statement. Of course, we've recently had Vlad, and we've spoken with Jason in the past. Jason, who is the CFO over at Robinhood, a huge kind of notice here that they have to file on the Wells notice, and particularly within this 8K in the Form 8K that they completed. They said within there that, as previously disclosed, they received these investigative subpoenas from the SEC regarding the cryptocurrency listings, custody of cryptocurrencies, and platform operations, and that they are cooperating with this investigation right now. So we're tracking shares of Robinhood going into the start of today's trading activity here.
Yeah, and I'm taking a look at a blog post here written by Dan Gallagher, the Chief Legal Compliance and Corporate Affairs Officer at Robinhood, saying that after years of good faith attempts to work with the SEC for regulatory clarity, including our well-known attempt to come in and register, we're disappointed that the agency has decided to issue a Wells notice related to our U.S. crypto business. So again, Brad reached out to Robinhood, and of course we'll update you with any further updates that we're getting here on this breaking story.
Absolutely. Well, speaking of crypto, let's talk a little Bitcoin here this morning. Bitcoin pulling back slightly, hovering just above $63,000 here. For more on these moves, we've got Yahoo Finance's Jared Blickery. Jared, what are we seeing here?
Well, as soon as we put the Wi-Fi Interactive up behind me, you're going to see a bit of red. This is just over the last 24 hours. Solana bucking the trend there. That's in the green, up almost 4%, but you can see more red than green, especially for some of the bigger names. Now, last week was notable because it was the first huge week of outflows from Bitcoin ETFs. In fact, the biggest one we've ever gotten. I'm going to put a year-to-date chart here so we can kind of see what's happening. Now, Bitcoin has been consolidating above 60,000 all the way up to its record highs, just north of 70,000. And now, very characteristic of Bitcoin, it has dipped below and then it has risen back above a key support level. I've seen this so many times with Bitcoin. Is Bitcoin in the clear? It's too early to tell, but now we have this recent low that we can mark as a stop. So I would say 57,000, you don't want to see that price if you're a bull. But if we're above, especially above 60,000, as we are now, that is a pretty bullish sign. And if I sort by equal weight, I'm going to show you something else. There is more green than red here. So when we see, and just anecdotally, I've noticed that when we see broad participation in these crypto rally runs, it's kind of like with stocks. You want to see a broadening of the rally. That's kind of what we're seeing right now. Over the last 3 days, I'll get you that total before we leave here. Bitcoin roughly flat, Ethereum basically flat as well, guys.
All right, Jared, thanks so much. Appreciate it. We're going to continue to track all things BTC USD plus Solana and the other cryptocurrencies that you mentioned as well. We're also watching Paramount this morning after it formally opened acquisition negotiations with Apollo and Sony, according to a report from the New York Times. This comes after its exclusivity period with Skydance. It ended Friday. Yahoo Finance's Alexandra Canal joins us with the details. Hey, Ali.
Hey, Brad. Yeah, at this point, we're just waiting for an update from Paramount Special Committee when it comes to these bids. That special committee evaluating all of these potential offers. And per these media reports, all of the offers are still on the table. That does include Skydance, along with that new deal from Sony and Apollo. Now, like you said, Brad, the exclusive negotiation window with Skydance officially expired on Friday, which is why Paramount is now able to entertain these other offers. investors overall seem to prefer the Sony Apollo deal. Now, this is a $26 billion all-cash deal for the entire company. Both Sony and Apollo are standing by the equity, so no financing is needed, and it would make Sony a majority shareholder with Apollo Global acting as that minority shareholder there. Now, Apollo is the parent company of Yahoo Finance, we should mention, so that's the preferred deal for investors. However, National Amusements, which is a holding company for Paramount, they seem to prefer this deal with Skydance. Now, the Skydance deal is a lot more complicated, hence why we're seeing this hesitation from investors. It would involve Skydance purchasing a majority stake in National Amusements and then merging that company with Paramount. So a bit of a two-step deal there, a bit complicated. Investors seem to think that deal unfairly benefits Shari Redstone, which is a controlling shareholder of Paramount. She is president of National Amusements. So we'll see where things go here. At this point, though, it does seem like all the offers are currently on the table. It just depends on what that special committee says. And then you have to think that regulation, that's also going to be an overhang in the background as well.
Yeah, Ali, I was out at Berkshire over the weekend, and clearly Paramount was a topic of conversation. There was lots of talk on Friday night leading up to that expiration of the exclusive offer there for Skydance. But let's talk about what exactly we heard from Buffett, clearly exiting the stake in Paramount. But really, I guess what that could tell us about how investors are thinking about investments right now or lack of opportunity within Paramount given the uncertainty.
Yeah, and Buffett took full, I don't want to say blame, but he basically said that he was the one that wanted to invest in Paramount and that they took their exit at a significant loss. And we've seen how back and forth this stock has been, right? There's been linear network challenges. The company is bleeding money in its streaming business. They've attempted to right-size the business and fix its balance sheet, but that's included moves like slashing the dividend, which we know investors don't really love. And at one point, Buffett was Paramount's largest non-voting shareholder. He purchased a stake worth $2.6 billion in May of 2022. He eventually added more shares later that year. But again, we've seen this company really struggle, and media overall is at this inflection point. So at the time, it did surprise Wall Street that he was so invested in this company, both literally and figuratively, but he's a media guy. He got his start in newspapers, and I think he really had a soft spot for this company. But with all of the murkiness surrounding M&A, with all of those challenges that these media companies have faced, it's not a great time, I think, for someone like Buffett, and he learned that, unfortunately, the hard way by
and also it was interesting what he said in the past, just in terms of the fact that he has been a bit critical of the streaming industry, just saying that he does expect to see consolidation down the road. Of course, looks like we're seeing that now. But also what stuck out to me was what he had to say about it's going to make him think twice or maybe reevaluate how people spend their leisure time, right? And exactly what that means for so many of these streaming giants going forward, and exactly how many winners we will likely see, or lack thereof, I guess, within this space. All right, Ali, thanks. Just minutes away here from the opening bell on Wall Street. Again, you're looking at gains for the futures. All three of the major averages set to open the day and the week in the green. We'll be right back.
Bing bong. My goodness, look at Figs ringing the opening bell at the NYSE. I mean, I'm so envious of the people who I see on the subways, the healthcare workers, our great healthcare workers in this state of New York and more broader across the 50 states and around the world. Why not? Those who rock Figs, I mean, it looks stylish.
They do look stylish.
Yeah, I remember when they went
a little bit, but yeah, they look very, very stylish.
You
That's
got
the reason why
Cognizant.
they've been a hit.
Yeah, Cognizant ringing the opening bell at the end, the Nasdaq as well. Think about some virtual funfetti. We love them too. Anyway, let's take a check of the market sponsored by Tasty Trade here. The first trading session of this week. Taking a look at the Dow Jones Industrial Average, it's up right now by about 0.5%. The Nasdaq and the S&P 500 also in the positive gains party as of right now. Fractional gains for both the tech-heavy average and the S&P 500 right now.
Yeah, Brad, when you take a look at, let's take a look at the Treasury markets here, just checking in on that movement that we started to see last week on the heels of that weaker jobs report. We're also seeing yields move down once again today off just about 1 basis point. But taking a look at the sector action as we kick off this week, you're certainly seeing a lot of green on the screen, at least here at the open. You've got materials outperforming as well as financials. Coming up in the rear, you have technology, a bit of an underperformer when you compare it to the broader moves that we're seeing more broadly here this morning. Also consumer staples, two sectors to really focus in on here as we talk about the trading week and some of those results that we will be getting out later this week. All right, Jared Blickery is taking a closer look at some of those key technical levels that we should be keeping an eye on. Jared.
Thank you, Shauna. We're going to put up the Wi-Fi interactive behind me. I'm going to start with the S&P 500. I'm going to show you a year-to-date chart and put the 50-day moving average. This is just the average price on a moving basis of the last 50 trading days. So here we are. We have now punched above that key level. I'm going to show you the Dow. Very similar. Just punched above that. Here's the Nasdaq. Similar story as well. Hard to see that little dot there, but we are above. And the Russell 2000. So all systems go here from that. From the perspective of some technicals. That also happens to be about the halfway back of this period of this length here where we drop from those highs to the lows. So we'll have to see if anything comes of this going forward. But one of the things I wanted to track here was our leading markets. And we see a lot of green here. We just overviewed crypto a few moments ago. We also have the New York FANG. That would be the mega caps leading cannabis stocks, ARK Invest, so that's a disruption trade, home builders. What's not working is Chinese stocks. Now, we had a great 2 weeks with them. I'm going to show you that's ARK Innovation. And here's China. That's what that's looking like today. But you look at the trailing month here. China has been a very depressed sector, and you can see it's finally starting to jump and come back. It's been at fits and starts. Admittedly over the last few years, and it's disappointed quite a bit, but nevertheless, we have the makings of another potential rally here for Chinese stocks.
All right, Jared, thanks so much for breaking that down for us. Well, markets are still betting that the Fed is going to cut rates in September. This after the weaker than expected jobs report that we got last Friday. Fed Speak on deck this week may give a little bit more insight or more clarity on the exact timing and the possibility here of a rate cut. To break it all down, we want to bring in Sam Stovall, CFRA Research Chief Investment Strategist. And Sam, it's good to see you. So let's talk about the moves that we saw at the end of last week. We saw gains. Here we are again, opening the trading day here on a new week. We're pushing even further here to the upside. Lots of optimism that we're going to get a Fed rate cut. Do you think that's the right read?
Hey, Shauna. Yeah, yes, I do think we're going to get a rate cut. Actually, I think we might end up with two, possibly first in September and then the second in December. And no, September is not too close to the election. Interesting, but if you go back to 1992, when the Fed really started telegraphing Fed funds rate changes, every presidential election since 92 except 2012 saw a rate hike or cut take place in an election year, and many of those took place in that third quarter. So there is still the possibility that the Fed will try to let us know that they are apolitical and do what they think is right for the economy.
I mean, there's two meetings that are prior to September as well here that are still on the docket, Sam. So what can take place in terms of the trend that the Fed is looking for, perhaps being thrown off course to the point where they would need to recalibrate their own assessment?
Morning, Brad. Well, I think certainly looking at the employment data this week, we're pretty ho-hum in terms of economic reports. But next week, when we're looking at CPI and PPI, the encouraging bit right now is that the street is anticipating that the April data will end up being softer than the March data, and that could further encourage investors that maybe the Fed is closer to their first rate cut of this period. So I would tend to say, obviously, that the Fed reminded us that they are data dependent, and they will continue to monitor everything and make the decisions based upon that.
Sam, what do you expect to see just in terms of the improvement on inflation? We've kind of been trending sideways now for just a bit. Why is the market so confident that we are going to see that further improvement then to the downside?
Well, I guess you could say that investors are a little bit like hyperactive first graders playing musical chairs, always trying to out-anticipate the other as to when the music will start or stop. And then knowing that we're not going to be seeing a rate hike, chances are. So therefore, a cut is the next step. And investors are anticipators. Traditionally, there has been an 11-month separation between the last rate hike and the first rate cut. We've had 6 of those, 5 of the 6 times going back to 1990, in which the market rose. The average increase was about 14%. So essentially, investors are saying, we know that a rate cut is coming. We just don't know exactly when, but we are going to play into this optimism by buying whatever dips there happen to be. And that's why, as Jared just mentioned, there's a good likelihood that because we're closing above the 50-day moving average, could be encouraging that this pullback of only 5.5% has concluded.
Yeah, Sam, you triggered my own memories of making a bunch of jab steps towards the chairs during musical chairs, trying to time the music here. So thank you for that. You know, ultimately, investors trying to figure out if they need to be doing any repositioning going into and amid an environment where we're hearing for less rate cuts than anticipated to start this year, especially off of Friday's employment situation data. And, you know, God forbid an investor took the day off or started the summer Fridays early after we got that weaker than expected print.
Well, I think what's interesting is that we're starting to see more attention be paid to some of the defensive areas of the market, in particular utilities. I think investors are saying, you know what, this group is trading at a more than 20% discount to its long-term relative PE. It's been under pressure because of the uncertainty surrounding the rate cycle. But I think that because valuations look relatively attractive, and we are in the traditional sell in May period, which is sort of challenging for investors. In election years since 1990, the S&P has gained only 0.5% from May through October, whereas the more defensive sectors, consumer staples, healthcare, utilities, have posted increases in excess of 3%. So I think investors are sort of playing it safe by adding to their positions with utilities.
Sam Stovall, CFRA Research Chief Investment Strategist. Sam, great to speak with you as always. Thanks so much for kicking off today's trading activity with us.
My pleasure. Thanks.
Absolutely. Well, crude prices are climbing today. This as hopes of a Gaza-Israel ceasefire are slimming, and Saudi Arabia is raising prices for some regions. To break down the price moves, Yahoo finance reporter Inez Ferre is here. Hey, Inez.
Hey, Brad. Yeah, and just taking a look at crude right now, we are seeing that it is higher. Part of this has to do with Saudi Aramco raising its prices for its Asian markets. So its Asian customers are now seeing higher prices from Saudi Aramco. That is sending the price of Brent, the international benchmark, higher. Also, WTI is higher as well. As far as OPEC Plus is concerned, as some analysts are expecting OPEC to continue with its production cuts into beyond June. There are some analysts that feel that perhaps OPEC could bring in more supply, bring in more capacity because they do not want to lose market share to the U.S. and others. But nonetheless, a broad expectation is for these production cuts to continue, especially if we see prices with Brent below $85 a barrel, with WTI below $80 a barrel. As far as the geopolitical front, the probability of a ceasefire slimming, that has been also sending crude prices higher. So some of what you're seeing right now may be on those renewed geopolitical risks, guys.
All right, Inez, thanks so much for continuing to track this for us. Appreciate it. All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance's coverage here at the Milken Conference in California. Lots of focus in these halls on the outlook for interest rates and the economy. Joining me now is a very special guest, Apollo Global Management CEO Mark Rowan. Good to see you again.
Thank you. Thanks for having me.
Appreciate it. So within the businesses that Apollo owns, what have you seen, or what has the impact been from higher for longer interest rates?
Very little.
Very little.
Very little. The way I go through it is you think about what's happening in the economy and what's happening in the U.S. 3 years ago, we decided to build infrastructure. There's no infrastructure opened. 2 years, semiconductor plants, no semiconductor plants opened. A year ago, Inflation Reduction Act, none of those plants opened. We've been reshoring our supply chain. U.S. has been the largest recipient of foreign direct investment last 3 years in a row. Something tells me we're ramping defense production. All of those things are stimulative to employment. And it does not surprise me. Everyone who wants a job has a job, which means it's very hard to dent the economy. Maybe financial markets, yes, but the underlying economy is strong.
So soft landing achieved, do you think?
I think we've had a soft landing. When rates have gone up 400 basis points and the wheels haven't come off the bus, as they say, I think that's the definition of a soft landing. Will it continue? I think so.
Do high interest rates do they matter to a business like Apollo?
Look, interest rates, the level of interest rates always matter. I'd say it matters almost in reverse. I think investors kind of deceived themselves that they were good investors for the past decade, rather than riding an era of very low interest rates. I mean, look at what's happened in real estate. Look at what's happened in other interest-sensitive investments. You thought you were the best investor in the world. You moved to Austin, Texas. You bought all multifamily. It was going great.
Yeah.
The changing cap rate has halved your investment. And now your 3.5% mortgage is being refinanced at 7.5%. You did everything right. You just didn't watch what was happening to interest rates.
I'm an avid listener of your earnings call, Mark, so I will go back to the recent one. And you talked a little bit about investors being levered to NVIDIA, Apple, and Amazon. What do you think the impact to markets have been because of that, being levered to those stocks?
Look, we are in a liquidity-driven, an interest rate-driven, a sentiment-driven market. And, sometimes I ask, particularly academics, do we even have price discovery anymore in U.S. markets? It's not clear, especially when you look at what a hard time active management of equities. Here are people who have spent their whole lives becoming good investors, and they as an industry have failed to beat the market 93% of the time for 20 years. Did these people get stupider? No. But did the structure of markets change so that we have positive reinforcement of cyclical flows into index funds and other forms of passive investing? I think we have fundamental changes in market structure that we have not dealt with as a society yet.
So to the investors that are, look, I see it on Yahoo Finance, they love these stocks, they love these companies. What's your advice to them? Is now the time to rethink how you invest?
So look, I'm not in the stock picking business, but very few people come in every day and try to buy 45 or 50 PE stocks. It's just not what we do. I look at the broader trend. We used to have 8,000 public companies. We now have 4,000 public companies. People think most of the action is in public markets. 80% of companies over 100 million of revenue and 80% of employment is in private companies. How do investors have exposure to private companies? Well, the answer is they don't. Institutional investors have it through a product, private equity. But most investors don't have any exposure to private markets. We are just, as an investment world, dipping our toe into private credit. So if you think of the two big buckets that investors have, debt and equity, debt is going first. In debt, there are things like rating agencies that tell investors the level of quality between public and the level of quality between private. And if investors can earn higher returns and have better diversification in private markets, or by adding private markets to a public portfolio, they'll do that. It'll take time in equity, but I joke that they may not own private equity in funds, but they will own equity that is private. And it's our job as an industry to create products that allow investors to come into this marketplace to get the benefits of higher returns and diversification.
I can't think of really anyone that could speak to this better than you, Mark. Are we in a retirement crisis? And then how do we get out of something like this?
Look, we are worldwide. It's not just we in the US, everywhere in the world. We have, Western world at least, we have aging populations, we have governments who are doing less, and we've had an era of very low interest rates. For the most part, people have not saved appropriately for retirement. How do we get out of it? Slowly. There's no magic bullet. You look at places around the world where they've done an amazing job. Take Australia, superannuation funds. What's been the secret? Well, the secret in part has been forced savings on an annual basis, matching from employers. But a big part of the return, superannuation, the design of it was to give public investors access to private markets under professional supervision. Contrast that to what we're doing in the US. We have between 12 and $13 trillion in 401k plans. What are these people invested in?
They don't know.
Well, I'll tell you, on the whole, they're invested in daily liquid mutual funds and ETFs for 50 years. Why are they daily liquid for 50 years? I don't know. We haven't thought about it in a really long time. Giving people access to the totality of a marketplace, public and private markets, I do think is heading our way. I think for our industry, not just for Apollo, this is a very bullish thing. We have built a whole industry out of a very small bucket called alternatives. We are branching out now and taking over pieces of the fixed income bucket of our large investors, particularly the investment grade private credit bucket. It will not surprise me on the horizon to also think about equity across public and private markets, and not just in private equity fund format.
In the couple minutes that we have left, Mark, I have just two final topics. You were really one of the first leaders to speak out on anti-Semitism at college campuses. And since then, things have really hit another level. I think USC campuses are closed today. What's your take or read on the current situation, and ultimately, what's the end game of this?
Look, it's hard to give you the end game, but I say very tongue-in-cheek, unfortunately, the fight against anti-Semitism is a growth industry. And that's what we're seeing right now. The protests we're seeing on college campuses, are they anti-Semitic? They are absolutely anti-Semitic. Are they anti-American? They are anti-American. They're actually anti-Western. We're thought of as these protests are leftists. I used to think of the left as liberal. Now the left is illiberal. Where is this going? I think the vast majority of professors at these universities, the vast majority of students, the vast majority of people in this country totally get that there is a way and a right to protest. People should have free speech, people should protest, but there is also a way to take over, to cause damage, to threaten, and to intimidate. And this is a failure of leadership. You look at places like University of Florida, University of Texas, and Vanderbilt, where the leader came out and said, free speech, yes. Right to protest, yes. Time and place, appropriate. They don't have the problems that you have on other campuses where the leader was somewhat ill-defined in terms of the rights. And the notion that we've been catering to a small group of people who hold extremist views, they're entitled to those extremist views. What they're not entitled to is to impose their will on the rest. So I do think we're getting a little bit of a snapback here where people are just tired of it.
Well, I know a lot of people appreciate you speaking out on this, Mark. And last but not least, and look, I understand you can't talk a lot about any potential bid for Paramount. I get it. But where does Apollo see value in an asset like that? Can you help us understand the thinking behind it?
Look, we are a purchase price matters, value-oriented firm, and the way value is created today is usually in places that are undergoing substantial change. So media as an industry, I don't have to tell you, sitting in Yahoo, that media is undergoing substantial change. The notion that you could come in and build on a great business and try to navigate through these turbulent times, I think is where we create value. We historically have been long investors in media. We've done it across almost every sector in media. Obviously right now we are invested in Yahoo. We are also invested in Legendary. And by bringing along a respected industry partner, Sony, I think we look at this as just an interesting opportunity to create value in an industry undergoing change.
We will leave it there. Thank you for always giving Yahoo and Yahoo Finance time. Mark Rowan, CEO of Apollo Global Management. Good to see you again. We appreciate it.
Total pleasure. Thanks for having me.
Thank you so much. We'll be right back.
We're keeping tabs on shares of Boeing today. The aerospace giant set to launch its first crewed space flight to the International Space Station. This is coming Monday night. This is a key final test before NASA can authorize Boeing to conduct routine flights to and from the space station for the agency. Now, if it's successful, it would enable Boeing to challenge Elon Musk's SpaceX. But it's a critical time for Boeing, which is facing a safety crisis after a door panel came off of a jet mid-air. Just yesterday, ISS recommending shareholders vote against the outgoing CEO David Calhoun's pay package. So a lot certainly swirling around shares of Boeing over the course of this year in 2024 thus far. However, this would be a very serious step forward in a business segment that is outside of the large plane manufacturing division for Boeing right now. We're taking a look at shares up fractionally here this morning by about 0.5%.
Yeah, this is significant because we know Starliner has been plagued by numerous technical issues over the years. So what's happening tonight, that launch expected to happen right around 10:30 p.m. here from Florida. It's going to be a key test here just in terms of whether or not Boeing is able to successfully and safely bring people up to space. Now, we mentioned that could obviously be a catalyst potentially here for Boeing in the short term. We also got to talk about the CEO pay package and some of the pushback that we're getting against that. Not necessarily a big surprise given the events that have played out here at Boeing over the last several months. But to put this pay package in perspective, it's just around $32 million. Now, the ISS citing some concerns over the Specialty Equity Award and the sizable increase in the long-term incentive grant. It would be about 45% of a pay jump here from what he earned a year ago. So 45% jump for this pay period potentially, given the fact, and this is in light of the fact that Boeing has had several issues, lots of questions about what exactly Boeing's future looks like, not to mention Calhoun is going to be stepping down by the end of the year. So questions just about the leadership structure going forward, who best and who is going to lead Boeing in this new era after Calhoun does step aside. So lots of pushback, not a huge surprise on this massive pay package here for Calhoun.
Yeah, it seems like every year for the past few years here, there's been a major vote on pay packages, whether it be Tesla most recently and Elon Musk. You go back prior to that, Netflix, Ted Sarandos, and the co-CEOs there. And then additionally, Intel just the year prior. I believe that was in 2022 as well here.
All right, well, coming up, keep right here on Yahoo Finance. Madison Mills is going to be joining me for our brand new show, Catalysts. You won't want to miss that. We'll be right back. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and welcome to our brand new show, Catalysts.
From equities to commodities, we're decoding trends and uncovering the drivers behind today's market moves.
Our team of experts, they're here to help you navigate all possible outcomes to make the best decisions for your portfolio.
It's Monday, May 6th, so let's dive into the catalyst moving the markets today.
First up, market attention is likely back on earnings with some major names outside of big tech set to report. Results from Tyson Foods, Disney, and Uber among the long list reporting this week, so any guidance on the consumer is going to be closely watched. But it's not over for tech. AI spend will yet again be in focus later today when software company Palantir reports.
Plus, Warren Buffett's cash pile hitting a record high, and he's happy to keep building it up. The Oracle of Omaha adding that Berkshire Hathaway will continue to hold its favorite companies, among them American Express, Coca-Cola, and Apple, though it did trim holdings of the iPhone maker this quarter, putting some pressure on the stock.
And lots of Fed speak here on deck. Richmond Fed President Barkin and the New York Fed President Williams will speak later today. Friday's Goldilocks jobs report putting a possible rate cut back on the table. Investors are closely watching for any indication of policy timing in today's commentary. So let's start there. This morning, rate cut optimism from Friday's jobs report continuing to push markets higher in today's trade. Traders now pricing in a rate cut in September. Joining us now, we want to bring in John Stolfus. He is Oppenheimer's Asset Management Chief Investment Strategist. John, it's great to see you again. Let's start with the new note that you just put out this morning and was titled "The Song Remains the Same." So what does that setup then look like for equities, and how much upside do you really think we have from here?
Well, thanks for having me on the show, Shauna. I would have to say, at least we think upside from here to the end of the year. You know, our target of 5,500 for the S&P 500 remains the same. Our expectations here are that, you know, near term, we're bound to have volatility. The longer it takes the Fed to actually give the market an idea that it wants to believe as to when it's going to cut rates, that's all another story. With our thought is the risk in terms of volatility increases the longer the Fed remains on hold and the economy continues to slow. The question will be, when does the economy go into a recession? We think the Fed thus far, after 2 years of raising rates and pausing, well, 11 hikes, 7 pauses now, with no recession, has probably got a good chance to avoid a recession here. But it'll be kind of, you know, it's going to take time. We don't think the Fed cuts until the second half of the year.
Do you have a date on that, John? December?
You know, December is our favorite one. It almost seems inevitable. We think that'll be the thank you and good night, you know, in terms of closing out 2024 for the Fed. And would be elegant in the sense that it will avoid any comments from different corners of the market about the cut being politicized by a presidential election year. And I think the independence of the Fed is very valuable, not only to the United States economy, but also to the Fed itself and for its legacy.
Well, John, in your note, you say that the Fed's data dependency continues, in your view, to be the best course of action to deal effectively with the vexing, sticky inflation that we have seen. But as you know, that data dependency is causing a lot of whipsawing, particularly in the bond market. We're seeing the 2-year move 30 basis points over the course of the last week after some of that data. Is that whipsawing a problem associated with data dependency, or is that a necessary symptom of it?
I think it's an inevitable symptom of it, in the sense that, you know, the bond market, in essence, usually the short end of the curve is very much tied to where the Fed is, which means no cuts for now, higher rates at the near end, while at the far end, the thought is the Fed is going to do the job. But on so you do have a somewhat inverted yield curve, not necessarily suggesting a recession in this environment. But the other would be, the thought is here that the market's expectation within the bond market and the pricing of bonds will remain volatile, likely, with the 10-year hovering likely from as low as perhaps around 3.8%, like we've seen, I think, earlier this year, to as high as probably getting close to 5% from time to time, because that's got to be a lot of emotion and excitement in day-to-day trading, an opportunity for traders to make money, and for intermediate to long-term investors to buy babies that get thrown out with the bathwater, whether it's in volatility, hitting equities from time to time, or hitting the bond market. Attractively price securities will be available through the process of volatility. But it's not the end of this bull market, and we don't think it's the end of the no recession environment with the Fed in the hike cycle.
John, let's talk about earnings season so far, because you crunched the numbers. It was, in your most recent note, about 5% earnings growth so far this quarter. It's the highest level that we've seen in nearly 2 years. I'm curious to get your perspective here on earnings so far, if it's enough, whether or not it's enough here to support those future gains, but then also just looking underneath the surface here and talking about what is driving that earnings growth. How much of it is driven by the cost cutting that we've seen?
Well, probably a lot of it is driven by cost cutting, but it's also driven by CapEx in the sense that when we look at, have to look at my screen for this because this moves on a pretty well daily basis, but earnings for communication services, with 12 of 19 companies having reported, earnings growth is up. Are we sitting down 42.25% year over year on the quarter? Then in the case of consumer discretionary, earnings up 40.56%, which gives indication that there is interest in search services, advertising, and in terms of the consumer is still buying stuff, if switching necessarily away from more expensive items and more private label or big box kind of delivery for what they're buying.
So then, John, extrapolating that and also pairing that to going back to your comments earlier when you talked about the economy might be slowing a bit when you take a look at the jobs report that we got out last week, when you take a look at ISM suggesting some slowness there. What does that then tell us just about the short-term trading action that we're likely to see?
Well, it'll certainly bring in more questioning from both sides of the, not political aisle, but here both sides of the investment stories, the traders versus investors aspect, and will likely create, as we mentioned before, the opportunity to pick up things cheaper for investors from time to time. I don't think drastically cheaper at this point. And for traders, the day-to-day action that can be found in uncertainty. But for us, when we look at it, this is, Sean, I've been in this business for a little over 40 years. It's going to be 41 sometime between May and July, if I'm correct. And I've seen every boom, bust, and recovery cycle. And the extraordinary one about this is that you've got such changes in innovation that really enable both the corporate entities as well as the analytical community, the economists, and the consumer to navigate tougher times with technology more effectively. And it's enabled the Fed to deliver this so far recessionless recovery process.
All right, John, thank you so much. Always great to speak with you. And congrats on that upcoming anniversary. We'll be sure to send you a note then. Thank you so much. That was John Stolfus joining us from Oppenheimer there. Well, investors are closely watching Palantir today ahead of its earnings report. That is expected to come up after the bell. The big focus remains on any further developments from the company's AI applications. Shares of Palantir are up 45% so far this year. So the big question, Shauna, are they going to be able to continue that growth? And of course, our very own bull in front of the show, Dan Ives, saying that they absolutely will be. But he's particularly watching growth of the U.S. commercial segment of Palantir, expecting them to get a significant chunk of the $1 trillion global market for platforms like their own.
Yeah, and I think the other big question is going to be what the pipeline looks like for some of those larger players and exactly how Palantir sees that developing here going forward. And then also what customer demand looks like for their AI platform. And AIP is what they abbreviate it as, and exactly what that adoption rate looks like. We know when you look at the performance of Palantir, you mentioned that year-to-date performance over the past year, I think the stock's up just around 200% or something like that. So a lot of that has been driven by optimism surrounding AI, exactly what Palantir's role is going to be in that AI adoption story here going forward. So any sort of disappointment there, look at that again, nearly 240%. So any sort of disappointment there, of course, could potentially weigh on the stock here going forward.
Right, a question about whether or not they might be priced to perfection, but if they keep delivering, then who cares?
All right, well, you got to keep it right here on Yahoo Finance. Much more coming up on Catalyst. We're going to have reaction to Berkshire Hathaway's annual shareholder meeting, and that's coming up. Stay tuned.
Let's do a quick check of the market, sponsored by Tasty Trade. You're seeing green across your screen here, across the major indices, plus across various sectors. The S&P up 0.6%, similarly with the Nasdaq, and the Dow Jones is in the green as well. I'm taking a look at which sectors are performing well across the S&P 500 today. It's looking like a sea of green here, not a lot of laggards in the space pulling this sector down, and specifically seeing a lot of good movement in some of our big tech names here. You've got NVIDIA in the green, as well as some of the other major chips players, SMCI, of course, in the green this morning as well. Some of the specific laggards are smaller guys on the street, so they're not hitting this top line number very much. And that larger picture of post-jobs reports still seeing some gains across your screen as we enter the trading day this morning.
Taking a look now at shares of Tyson Foods. After reporting second quarter results, the food processing company posting an earnings beat. Even as sales slip, the company starting to benefit from cost-cutting measures. You're looking at a drop of just about 6.5%. When it comes to the quarter and some of the demand trends that Tyson has seen, they were talking about some tailwinds from their chicken business, that it was enough to offset the slowdown in beef. We have seen more and more consumers, as they have been under pressure here from inflationary pressures here, turning to more affordable options. Chicken producers, chicken manufacturers, they're benefiting from that. So Tyson able to offset some of the slowdown within their beef business from tailwinds that they're seeing within chicken. But they did have some cautious commentary when it did come to their chicken business going forward. They said that the U.S. chicken production issues is not a short-term fix. So because of that, and because of some of the other updates that we're getting here from this call, we are seeing a bit of pressure on the stock here this morning.
This to me feels like another story about a stock that was able to be defensive but not offensive this earnings cycle. I guess that Brad and Brian are beefing up the beef sales this quarter, so we're seeing that. I feel like everyone's buying chicken as an inflation hedge, but there you go. People are still buying beef. Having said that, Micron shares also raising here after Baird upgrading the stock to outperform from neutral, noting meaningful upside opportunities ahead for Micron. And what's interesting about this upgrade is that this was one of the guys on the street that was really holding out here. So that's why we're seeing a big movement to the upside after that upgrade in particular, because he had really held out for a significant amount of time. And so there wasn't necessarily an anticipation of that coming. He did admit that the call was a bit late, but noted that the shares have pulled back recently. They are down over 10% from their record high close in early April. But as I said, they do see a meaningful upside to come for Micron here.
Yeah, so they're naming them or adding them to their list of top semiconductors ideas. Just to give you a better perspective of some of the other names that they see outperforming here, at least in the short term, they have NVIDIA, Broadcom, and Semtech also among them leaders, or among the members of their list there that they say leading the way for the chip stock. And like you were saying, a lot of this, it seems to be a valuation play. Yes, there are trends that are improving within the sector, but also this comes after the recent pullback that we've seen in Micron stock. So they're saying it's a bit more affordable at this standpoint. They're upgrading Micron, adding it to their list of top semiconductors ideas. And as a result, we're seeing some movement here to the upside in shares this morning.
And John was talking about that too, this idea that the PE ratio is looking a little bit better, valuations are looking a bit better. So question of whether or not that could eventually be a bearish signal if they continue to decline here. But so far, so good. We're going to move on to one more trending ticker here. Shares of Perficient surging as EQT agrees to buy the global digital consultancy in a deal valued at about $3 billion, including debt there. You're looking at a huge surge in that name. That is ticker PRFT, up over 52% this morning. And this comes after a slew of similar deals from EQT, particularly looking in the AI space. So it's interesting to see that that is sort of continuing to be their MO at the moment, at least when it comes to some of the deals that we've heard from them as of late, Shauna.
And this deal has been unanimously approved here by Perficient's board. The companies here said that Tom Hogan is going to continue as the chief executive, as CEO, while the current management team will also remain in place. So again, we're seeing a bit of a reaction. No surprise to Perficient stock here, up just about 52% on the day. All right, we're also continuing to cover the biggest headlines coming out of Berkshire Hathaway's annual shareholder meeting this weekend. You talked about everything from the record high cash pile to Apple to Paramount to AI. So who better to speak to about this than Cole Smead? He's the CEO of Smead Capital. Cole, it's great to have you. So I was actually out in Omaha with Bill over the weekend. We were listening to what the Oracle of Omaha had to say. I'm curious, from everything that you heard over the weekend, what was the number one thing that stuck out to you?
The most surprising thing was that Todd and Ted are fairly sidelined. In other words, they're going to pick stocks for Berkshire Hathaway, but they're not going to be the primary capital allocator, which is actually going to be Greg. So I think that was surprising. That was unlike we'd heard before. It was really new information. Maybe the board was privy to that, but I think shareholders should be more surprised at that.
What does that tell you about Berkshire stock moving forward and their performance? Does that lead any kind of concerns to you?
Yeah, it's really, I think it's a different company compared to what we know as the Charlie and Warren shtick of the past. I say that because they were investors that became operators. What we're talking about now is Greg as an operator to be an investor. I think that's a much tougher transition. I know a lot of operators who are really good at what they do, and then when you go to ask them to invest, it's just a different person to ask that kind of need. But I think also one of the most interesting questions of the day was when a young man asked about Buffett if he'd rather be doing what Charlie recommended, which was buying a few great companies at a fair price, or going through the Moody's manual, the 20,000 pages of the Moody's manual. And here we sit where Buffett is sitting on this massive cash pile. He's selling his Apple, giving what I'll call it some capricious reasons for doing so. And he's saying there's not a big $10 billion investment opportunity. And he's saying if he had less capital, he'd much rather be digging around for the vast number of opportunities. I think that's a good picture for investors. I think that was the biggest megaphone experience people should have had, is in the big opportunities out there. There are few. And when I say big, let's say Berkshire can't own bigger than a 10% stake, and they got to invest $10 billion. All Buffett's saying is any company $100 billion or greater, there is no opportunity. And I think of that against everything we're talking about, the stock market, what's driving the stock market. It's nothing but $100 billion plus companies. So I think investors should very much wake up to that. And I think the only difference between this and the past is Buffett. If he was 40 like I am, he would be telling everyone how terrible things will be going forward in stock market returns like he did in 99 at Sun Valley. He's just old, and you know what? It's just not in his best interest at this point to do that.
So Cole, what does that then mean for Berkshire's growth going forward? What does that mean for their priorities? And when you talk about the lack of investment, that was something that Buffett mentioned many times, and what you were just referencing there over the weekend. How long do you think it's going to be until we see Berkshire start to put more of that cash to work?
Yeah, well, let's just use 2020 as an example. You'll see that they put very little cash to work back in 2020. So if someone says, what would it take? Probably like a 35-40% bear market in the S&P 500. They have to have the biggest companies get smashed. And by the way, I think that will happen. It will happen, and most people don't believe it can happen. I only point that out because I think the most analogous picture, you had the Oppenheimer strategist on just a second ago. He talked about how all wonderful these things are. Yes, when Cinderella was at the ball, it's always wonderful. It's fantastic. The drinks are great. And then the clock strikes 12 and everything turns back to pumpkins and mice. This is a gestalt in that we think these technologies and everything is greater than it really is when we're running massive deficits and we're paying stupidly high multiples for things. And the question is, can those two things hold? If they don't, we're going to find economic growth that might not be as good as we think, and we're going to find that stocks aren't as great as we thought they were. And so I just point that out because that's really what Buffett's playing for. That's what they're building Berkshire for. And a 20% bear market in 2020 did not cause them to deploy capital. 2022 did not cause them to deploy a lot of capital. They're looking for a smash, drag out kind of market. And I don't think most investors think that can happen, to be honest.
Okay, well, let's talk about one investment opportunity that Buffett got invited to over the weekend. Buffett said that auto insurers like Geico, obviously owned by Berkshire, are at risk if self-driving cars do hit the market, to which Elon said, come on over. Do you anticipate that relationship starting?
Yeah, I love this question, to be honest, because Ajit answered this, and he pointed out that the incidence of problems with self-driving cars is lower than the human. And I would agree. I mean, I live in Phoenix, Arizona. I send my daughters in Waymos to the mall, okay? Self-driving cars taking my daughters to the mall. It's a picture of the future, in my opinion, because my time is worth more. But here's the catch. To Ajit's point, that car costs so much more that when a problem does arise, the insurer is insuring a larger total policy. So if you take the likelihood of occurrence times the price of the occurrence, you're going to end up with, I think, are very similar economics for the insurer, and you're probably going to have fewer insurers because it will require more cash per occurrence. So I think those economics don't ruin the insurance business. If you're Musk, if there's anything you'd love to do, is you'd love to raise price. That's one of his biggest problems is he can't necessarily to get people to grow EVs. But I agree with Ajit. I think the cost of cars will continue to climb because the quality of cars that we drive continues to climb with it.
So ultimately, do you think Buffett's ever going to show any interest in Tesla?
Not a chance in God's name.
All right.
Pretty simple.
Cole, great to have you. Thanks so much for taking the time to join us here. Cole Smead, Smead Capital CEO. Thanks. We got much more of your market action ahead. Stay tuned. You're watching Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
The U.S. Treasury is set to auction $125 billion worth of notes and bonds this week. We're watching demand at these auctions as an indication of how the market is thinking about the Fed's moves going forward. Joining us now is Michael Kudzil, PIMCO's Senior Bond Portfolio Manager. Michael, it's great to have you here. Let's start with the Treasury auctions that we are going to see this week. We've seen yields move just a bit lower. What are you expecting to see demand-wise for these upcoming auctions, and then ultimately what that signals here for the Fed and the market's path forward?
Yeah, thanks for having me. Appreciate the time this morning. Certainly, significant size of Treasury auctions for this week and for the foreseeable future. Although Treasury auctions won't be increasing, they are at record high levels, and so a lot for the market to digest. But nothing the market can't digest. We've seen the market digest similar levels of supply, and they'll continue to do so, whether it's at slight concessions to where we are now. But these levels of rates, just peeling back the lens, are quite attractive to investors, and we can dive into that a little bit deeper. But the rates on offer today, 5.10 on the U.S. Ag, real yields of 2.25%. These are levels that aside from 4 months in the past 15 years, you haven't seen. And so these are yields that are attracting investors. And whether or not there needs to be a slight concession this week to absorb these auctions, bigger picture, these are yields that are attracting investors. And given what the Federal Reserve told us last week, it seems like these are levels that you want to start adding duration to portfolios.
What does that duration look like then?
So again, given the Fed's reaction function, which all else being equal, either they'll stay on hold for a little while longer, maybe eventually cut rates, but a hike is an extremely low probability, something they push back on several times. And so from that standpoint, we kind of like the belly of the yield curve, the 5 to 7 year point of the yield curve that will be correlated and respond to the Fed lowering rates. And all else equal, gives you a little bit of cushion into higher rates if that were needed. So again, we have a 4.5, 4 3/4, 5 year note that you've only had 4 months in the past 13 years. And that's something that, investors are finding attractive. And so from that standpoint, we kind of like the belly of the curve. We like we like holding hands with the Fed. And at some point they will begin to lower rates. Maybe it's a little further out than markets had thought. And that gives us comfort that at some point that will happen either later this year or sometime in 2025.
Now, Michael Powell did dismiss the potential here to raise rates, but I'm curious from your perspective, what is the bar for the Fed to hike?
I think the bar is pretty high right now. The Fed has this belief that inflation has moved materially lower from its peak. So we had inflation at 9% at the highs. It's down to a core PCE of 2.8. Whether or not it ticks back up to 3 something. This is not the inflation that it was a year and a half ago, and so the Fed views themselves as restrictive. Whether or not they are restrictive, I think we can certainly have that conversation. They view themselves as restrictive, and so they will need to be convinced with a fair amount of data that the economy is strong and momentum is strong, and inflation is not only holding but reversing and moving a fair amount higher. And so,
Michael,
yes,
is the Fed restrictive from your perspective?
I think that is an open question. I think based on their models of where they think the real neutral rate is, they are restrictive. I think based on the levels that we've seen in growth, based on the acceleration in inflation, I think you really have to squint to see the Fed and rates being restrictive. I think if you saw the first quarter that took place in credit markets, the borrowing that took place in credit markets, whether it's investment grade, high yield, and bank loans, that was record issuance. So folks borrowing and putting that cash to work, to me, doesn't tell me that rates are necessarily restricting activity. So I think it's an open debate. I think on the flip side, you can argue for lags. You can argue most recently we've seen a slight slowing, and maybe that'll continue. Right. And so I think it's an open debate, and I think we'll need more time and more data, but the Fed's going to need a lot more data to be convinced that they need to potentially move rates higher again.
Well, I wonder if the lag time that we need is going to be 30 years, because we know that, and this is from Torsten Slok, 95% of mortgages are in 30-year fixed rates. So is the lag part of long and variable lags going to take 3 decades because we're seeing so many people not impacted by rate hikes?
Yeah, so I definitely think the locked-in mortgages have certainly a lot to do with the strength of the U.S. consumer. The last time we had 5 1/4 mortgage rates, 30% of mortgages were floating. Today, 5% are floating. The consumer debt to GDP is the lowest it's been in 23 years. Consumers in great shape. It won't take 30 years. The average human stays in their home for about 7 years, but it could take more time. And that just means the consumer is more resilient. Not only are the locked-in rates, the consumer has more equity in their home than they've ever had in history. They have $32 trillion of home equity in their house, and that's also making them feel more confident in spending, maybe saving a little bit less because they've saved so much in their home.
So given that, if the Fed is at their 2% inflation target, we're looking at a crystal ball of the future here, what is the unemployment rate going to have to be at?
Yeah, I mean, we think the unemployment rate needs to move a little bit higher in order to achieve that 2% inflation objective. If you just look around at other developed markets.
So 6%, Michael, 7%?
No. I think 6 or 7% could lead to a 1.5–2% inflation, but that would also be a very different type of environment. We think 4.5 to 5 on the unemployment rate. So another 6/10 to a percentage point move in the unemployment rate would get us probably all the way back down to the Fed's objective. But we don't think the Fed's going to necessarily target their objective. 2 point something on the inflation rate with some confidence that we're moving in the right direction is probably enough for them to begin cutting rates. Again, we can argue if that's a mistake or not, but that seems to be the Fed's current rhetoric and way of thinking.
Data dependent, as always. Michael, thank you so much for joining us. We really appreciate your insights. That was Michael Kudzil, PIMCO's Senior Bond Portfolio Manager there. Now, a slew of Fed officials will be speaking this week to break down what we can expect from the Hawks and the Doves. Jennifer Schomburger is here with us. Hey, Jen.
Good morning, Maddie. This week kicks off a heavy list of Fed speak following last week's Fed policy meeting, where we'll hopefully get a better sense of just how different members of the Fed are viewing inflation, the job market, and what that means for setting interest rates. In the face of higher than expected inflation during the first quarter, last week, Fed officials said there was a lack of further progress on inflation dropping. While Fed Chair Powell said that a rate hike was unlikely, he took a step back from his easing bias, removing a prior statement that at some point it would be appropriate to lower rates. The Fed Chair also reiterated it will take longer to gain confidence inflation is moving back towards 2%. Then came the cooler than expected jobs report last Friday, offering hope for markets eager for a rate cut. So on the back of that report, traders have bumped up odds for a rate cut in September, up from December, but still only looking at one rate cut this year. After that cooler jobs report, will the tone shift again? Well, today we'll hear from Richmond Fed President Tom Barkin, who tends to lean a little bit more hawkish, along with New York Fed President John Williams, who's considered a voice close to Powell's. Tuesday brings Minneapolis's Neil Kashkari, who has said the Fed may not need to lower rates at all this year. Wednesday brings Boston's Susan Collins and Fed Vice Chair Philip Jefferson, also a close voice to the Fed chair. And later this week, San Francisco Fed's Mary Daly and Chicago Fed President Austin Goolsbee, both of which have taken a step back from 3 rate cuts that they saw earlier this year. Guys, on the back of this cooler than expected jobs report on Friday, it's unclear that really one report would move the needle. I think that Fed officials would probably need to see a slew of cooler jobs reports for that to really change their view. Of course, it'll be interesting to hear all these members of the Fed speak this week to see what their views are, whether they've changed, and whether that could change the calculus for rate cuts.
All right, Jennifer, thank you so much as always. Really appreciate you joining us there. We are going to have all of your markets action ahead, including a look at what's going on with Paramount. So stay tuned for more. You're watching Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Paramount shares are on the move this morning after the company formally opened acquisition negotiations with Apollo and Sony. That's according to the latest report here from the New York Times. We're looking at Paramount shares up just about 3%. Now, this news coming after its exclusivity period with Skydance ended over the weekend. Robert Fishman is MoffettNathanson's managing director and equity research analyst joining us now. It's great to see you. So talk to me just about your view on this Apollo-Sony bid and what is the more attractive potential outcome here for shareholders?
Well, it's interesting that you say for shareholders, but we have to define which shareholders we're talking about here.
That's a very good point.
So for independent shareholders, based on all the press reports, I think it's pretty clear that the Sony and Apollo bid is the best possible outcome. But of course, there's still lots of uncertainty here, and there's still a controlling shareholder in terms of which direction that she's going to choose to go.
So what do you think the path forward then looks like from here?
I mean, really, day by day, it continues to swing. Clearly, what we've just, as you mentioned, exited the exclusive window with Skydance, and now that opens up other potential possibilities. The company is also proceeding as if there's a potential for no deal to happen. So there's lots of uncertainty that comes to play with all these different scenarios, and there's some risks involved in that too. So as an independent shareholder, really you've been swung around and trying to understand how the future of this can go, because as an independent company going forward, there are still significant challenges ahead. And that includes fundamental challenges on the business that we follow.
Well, our own Brian Sozzi spoke with the CEO of Apollo earlier about the potential deal. Here's what he had to say.
We are a purchase price matters, value-oriented firm, and the way value is created today is usually in places that are undergoing substantial change. So media as an industry, I don't have to tell you, sitting in Yahoo, that media is undergoing substantial change. The notion that you could come in and build on a great business and try to navigate through these turbulent times, I think is where we create value. We historically have been long investors in media. We've done it across almost every sector in media. Obviously, right now, we are invested in Yahoo. We are also invested in Legendary. And by bringing along a respected industry partner, Sony, I think we look at this as just an interesting opportunity to create value in an industry undergoing change.
And as he mentioned there, I should say that Apollo is the parent company of Yahoo, but I want to get your take on that. It sounds like he's sort of touting the benefits of working with a PE firm in this deal, but I wonder to what extent folks should be thinking about the potential drawbacks, particularly given the regulatory environment that we're in right now.
Yeah, I mean, clearly we're in a more heightened regulatory environment, and that would put at least some of the potential upside of a deal more at risk, given the uncertainty that comes with that, and the current administration, and how they look at these types of deals. But as far as some of the value that can be extracted from a deal, clearly combining two studios would extract some synergy value there. So understanding that, but also it comes down to what are they going to do with the linear assets? And there are some better linear assets and some significantly challenged ones as part of the cable network portfolio that the Viacom holds.
I want to bring up some of the comments that we heard. I was out at Berkshire this weekend, and Warren Buffett weighed in on Paramount, saying that the company exited the stake that they have had in Paramount, talking about the amount of money that Berkshire has lost on that investment. But what was interesting here in those comments, to me at least, was what Buffett had to say just about the fact that how everything has played out has caused him to think a little bit more deeply about how people spend their leisure time. And we know he's talked about in the past the need here, or the likelihood that we will see some consolidation within this space. I'm curious how you're evaluating the potential winners within this space, and how many of these acquisitions you think are likely going to take place going forward until we get some more certain leadership within the streaming sector.
Yeah, it's a great question. Thank you. So I think as far as how we think about this, we've been talking about since really a couple of years already, that the streaming business is really not a great business, and especially when you compare it to how good the old business was in terms of the pay TV ecosystem. and how that you got paid regardless of engagement and regardless of churn and all of the issues that come into play with streaming, it's a much more difficult business to be competing against. And especially given the lead that Netflix has and how they've essentially already won the game. So where you go from here is there needs to be consolidation. We've been talking about that for a couple of years as well. And you need to have more rational players at hand so that they can get better economics out of the streaming ecosystem. But that's not to say it's going to be as easy to match the success and the profit levels that were generated in the old ecosystem.
Well, I'm curious then, you talk about kind of the need for consolidation and some, it sounds like basically more adulting in the room. What would that look like? What would success in that effort look like to you?
I mean, success means that you need to at least partner with other streaming platforms and not be competing against them, especially for the subscale players. So that will require different partnerships or combinations that come into play there. And then really from there, you need to also stop accelerating the demise of the pay TV ecosystem by leaking all of the premium content over the top and allowing consumers to watch all of the must-have content, primarily sports, in the over-the-top world at a discounted price to what they're charging to the wholesale players. And that leads us to the ongoing negotiation that Paramount is having with Charter right now.
So let's talk about what we're going to hear about the space from Disney tomorrow. They're set to report earnings before the bell. A number of key things that will be watched from the street when you talk about the impact on the parks business, what the health of that business looks like, when you talk about the summer box office, exactly what they're seeing there. But the big focus is really going to be on the streaming business and what exactly demand looks like within that space. I'm curious, what are you expecting to hear from Disney, and how big of a factor do you think that's going to be on some of these other larger streaming giants here going forward?
Yeah, I mean, we've been talking about for Disney that streaming is obviously the future, and it's partly the future of their company too. And so what do I mean by that? What we are looking for is a better strategy long-term in terms of how all of their different streaming platforms can come together to help them be that strong number 2 global player in streaming and compete with Netflix, given the assets that they have, and not compete on a pure content for content basis, because Netflix clearly has a different approach in terms of just the sheer volume that they bring to the table on streaming. But given the assets with sports and with Hulu and with Disney Plus, most importantly, and the library that they have on the Disney side, we think that Disney has all of the assets that can compete on a global scale basis.
All right, Robert, we're going to have to leave it there, but really appreciate you joining us. That was Robert Fishman, MoffettNathanson, Managing Director and Equity Research Analyst. Well, we got more news on Starbucks following its disappointing earnings results last week. Founder and former CEO Howard Schultz is urging change at the coffee giant following those results. He wrote in a LinkedIn post that the main problem for Starbucks remains in the United States. Yahoo Finance's Brooke DePalma has the breakdown.
Yeah, good morning to you both. Let's set the stage here for a quick second. Howard Schultz did step down as CEO last April, and he does not have any formal role in the company currently, but he is the 5th largest shareholder at Starbucks, and he is the single largest individual shareholder for the coffee giant. And he has taken to LinkedIn many times, but in the latest memo posted on Sunday evening, Howard Schultz said, quote, "The company's fix needs to begin at home. U.S. operations are the primary reason for the company's fall from grace. The stores require a maniacal focus on the customer experience through the eyes of the merchant. The answer does not lie in data, but in the stores." And he encouraged all senior leaders and board members to spend more time in the stores. And this comes, as you can see here, sales across the board are under pressure in all segments of the Starbucks business. He also added to that memo that the company needs to own the shortcomings without the slightest semblance of an excuse. But Schultz is not alone. Wall Street is also losing confidence. Take a listen to what Citi analyst John Tower told our Brian Sozzi on Friday.
I think there's a lot of frustration in the investment community with what's happening, and the investors want to hear a better, bigger, bolder plan from the company, perhaps some hard decisions around their path forward in the United States and in China.
And as sales do continue to decline in China, Schultz did add in that memo that he was confident that the China business will return to health and become the company's largest market. But as we know, the company is taking multiple steps in their mind, including value offerings, menu innovation, speedier service in order to get those customers back, get them spending more just like they used to, and ultimately turn this business around. It is 1 year since Lakshman took the role, and this is a pretty interesting time for the company.
Brooke, I'm curious, beyond John Tower, what some of the conversations that you've been having with other analysts, what are their thoughts just on Starbucks' pricing strategy? Because we talk about time and time again just how expensive Starbucks is, especially when you compare it to some of the cheaper options out there. Given the fact that inflation's still a real concern for so many Americans, are they rethinking, I guess you could talk about maybe some of that promotional activity that Rachel was speaking to us about, but are they thinking about maybe reevaluating that strategy going forward?
Yeah, well, John Tower added to the conversation by saying that there is a broad consumer pushback that we're seeing right now. And when we asked the CFO, Rachel Rogeri, she said that they're not planning to lower prices. But many analysts on the street are skeptical that these near-term fixes just are not enough to correct this it's maybe too far to say sinking ship that we're seeing, but definitely on the wrong course here. And they're not confident that these changes, these menu innovation, this value offerings are really going to get the consumer to come back and spend more. And without plans to lower pricing, many are skeptical that this is just not enough, that there are fundamental issues that the company needs to address first before they're introducing, say, a boba tea or pearl lavender or spicy lemonade or energy drinks, and many saying that this is a significant reversal to what we saw previously. So many are skeptical here. If these are enough, doesn't seem like the former CEO Howard Schultz thinks so. And of course, we've seen time and time again Howard Schultz coming back, taking a step in the company 3 times. He has said publicly that he does not plan to come back, but you just never know.
Until he does, once again. All right, Brooke, thanks so much. Thank you. Well, stocks starting the week higher as investors hope that recent econ data is going to put rate cuts back on the table for this year. One of the key takeaways today is that it might not be just the Fed that's driving stocks higher. We spoke to a number of strategists, a number of economists, but one of the conversations, Batty, that stuck out to me was what we heard from Oppenheimer's John Stolfus, and he was talking about the strong earnings season that we've seen so far this quarter. And putting that even in more perspective for our viewers here, we've seen about 5% growth so far this quarter. It's the highest rate of growth that we have seen for earnings in just about 2 years. And he was making the argument that coupled with the recent pullback that we have seen within the market, that's actually making valuations more attractive. We know John is one of the biggest bulls right now out there on the street. He's seeing some upside potential here between now, obviously, and year end. But I think that leadership is going to be the question, and exactly where that further strength comes from, especially in the second half of the year, something that's top of mind for many investors.
And we've been talking for so long about valuations getting out of control, and as he spoke with us about earlier, we're starting to see that subsiding a little bit. Also, looking at a stat here from Bloomberg Intelligence data showing that the S&P 500 outside of the Mag 7 is exiting its profit recession. So that is a huge indicator of the broadening narrative that we've been hoping to see. And again, kind of beefs up the bullishness that we heard from John this morning as well.
Yeah, because that's one of the key trends that investors are watching, strategists are watching, I should say, just in terms of that rotation out of the leaders that we had seen over the last 12 to 18 months, and more broadening exactly what that could signal here in terms of potentially bullish action that we could get in the coming months. All right, let's do a final check of the markets here. 90 minutes into the trading day, still looking at gains across the board. You've got the Nasdaq up just about 0.6%.
Coming up, we have our new show, Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for the next hour, where he'll discuss how retirees could potentially benefit from slower jobs growth. Stay tuned for that conversation next.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, how to invest like Warren Buffett. We reveal the biggest lessons from the billionaire's annual shareholder meeting. And haven't received your tax refund yet? Don't panic. We'll tell you what to do. Plus, marriage and money. We talked to an expert about how you should handle your finances in every stage of a relationship ahead of the traditional summer wedding season. All that and much more today. But first, let's start where we always do. Stocks are higher this morning, pegged to investors' hopes that the latest jobs report points to possible weakening in the labor market, and that weakening is just what the doctor, or in this case, the Fed, may have ordered here. A softer labor market, it actually points to some success in the Fed's efforts to curb inflation potentially, and that opens up the possibility of rate cuts, which could help alleviate the strain of high interest rates on consumers. So, all of that considered, what could this mean for your investment portfolio? Here with more, we've got Sandra Cho, who is the Point Wealth Capital Management President and Founder. Great to have you here with us today. Just walk us into your reaction, your thinking as you see that weaker than expected jobs print come out last week, and how that pertains to the Fed's policy pathway from here, Sandra.
Great to be here. Thanks for having me. So yes, it's exactly what you said. It would be wonderful if the jobs report, which came out, which showed less than expected jobs out there, it would be wonderful if that brought down inflation. And that would mean that we would have, less, less inflation. It would mean that perhaps the Fed would be able to lower rates this year. However, I'm going to just let you know that here at Point Wealth, we don't see that happening anytime soon. I would say if it's going to happen, it would happen maybe one time this year because inflation has been quite sticky. So, it's something to hope for.
And so specifically, as people are looking across the jobs figures here, where does that ultimately point you to believing that we are going to be seeing perhaps a trend that the Fed is looking for? Where will that trend begin to emerge?
They're looking at numbers really daily, and they're looking at them very carefully. So hopefully jobs actually, as sad as it's to say, it would help us if the jobs or unemployment started to tick up more. If you have less jobs, then there's less people to buy things. You're going to be more careful with your dollars. And then that would bring the price of goods down, the price of services down, and that would bode well, enabling the Fed then to start considering a rate cut.
And so if we did see that rate cut become enacted, as of right now, we're looking at the potential for September being the highest first moment. And then additionally, we're looking out to December. There's also the apolitical nature that the Fed wants to try and signal as well here. How does that play into this?
So one of the things that we're looking at is a possible rate cut, maybe in September, maybe even later in the year. We would hope that there is going to be unbiased consideration as far as the rate cut goes. But there's always some kind of bleed into, as far as in consideration into what's going on right now with the presidential election races. That said, also, like I mentioned, we see jobs, unemployment ticking up, and then inflation coming down. That doesn't necessarily mean it's a bad thing. And let's remember that on a daily level, Main Street really looks at and can bode well for, inflation coming down. You're going to be able to see prices coming down in the supermarket, in goods and services, and hopefully you're going to be able to, on a very personal level, save more. Because if you're not spending more as far as, just going out there, going to the grocery store, then you're able to save more both for retirement and your own personal finance.
Okay, so let's get to the goods here because a lot of potential and perhaps near-term retirees are trying to figure out how they can best position their portfolios. What is the investment advice or know-how that you're bestowing upon those who are getting closer to retirement right now, given the macroeconomic backdrop?
Sure. We see that the stock market has been going gangbusters last year and even year to date as far as large cap growth. and large cap in general. So big companies, but not all stocks are made the same. You see smaller companies like the Russell 2000 really underperforming. You see emerging markets at better valuations, and you see international developed markets like Europe at better valuations. And, that said, we're really looking to see more market participation as far as, equal market weight kind of coming back up. We're starting to really see that. For retirees especially, what's really nice is you're finally getting a decent yield in bonds. So if you're getting about 4.6% or so in bonds, and bonds have come down as far as price goes, about 2.6% year to date, if bonds just come back up to where they were January 1st of this year, you could potentially be looking at, if your entry point was right now, you could potentially be looking at a 7+% total return in bonds. That's really nice because you generally have less risk in bonds, less volatility. And that's especially good for retirees who tend to be more conservative.
Sandra Cho, who is the Point Wealth Capital Management President and Founder, thanks so much for taking the time here with us this morning.
Thank you.
Absolutely. Let's take a look at Spirit Airlines after reporting turbulent first quarter results, which is a top trender on Yahoo Finance right now. Shares of SAVE, the airliner, posting a decrease of 6.2% year over year on total operating revenues, noting a decrease 8.1% in total revenue per passenger flight. And then adding to that, on the far right side of your screen, that fare revenue per segment, that was down 16.3% in this most recent quarter. Spirit Airlines citing adverse weather and air traffic control related delays negatively impacting the company's operational performance. CEO Ted Christie saying the competitive environment remains challenging due to elevated capacity in many of the markets that the company serves. And while looking to the second quarter, revenue guidance is falling short of Wall Street expectations. So what's this mean for you, the consumer? The company also acknowledged that it's actively planning for a future that does not include a merger with JetBlue, plus plans to reduce near-term capacity. So that's how it impacts you and some of those routes as well that customers have come to expect over the years. We'll continue to monitor shares throughout the rest of the day. Also, we're tracking Disney here this week. Disney is a top trending ticker on Yahoo Finance ahead of its newest quarterly earnings report set to come from the Magic Kingdom in those first results since winning a board seat brouhaha against activist investor Nelson Peltz. For more on what you, the consumer, should be looking out for in Disney's earnings, our very own Josh Lipton joins us on set. Hey, Josh.
Brad, good to see you. Brouhaha.
Yes. You don't hear that tossed around.
No, you really don't. That sets the drama just right. Disney shareholders do, Brad, have to be feeling good heading into this earnings report. That stock is enjoying a strong run. It's already up about 25% so far this year. And analysts on Wall Street who cover the entertainment giant are fans. More than 70% say you should buy the stock. When Disney reports second quarter results, Wall Street is looking for earnings per share of $1.10 on revenue of $22.1 billion. Jamie Lumley is an analyst at Third Bridge Group. He tells me he is focused on the company's entertainment segment, of course. Remember, that does include Disney's traditional TV division, film and streaming business. As for traditional TV, Lumley not expecting much. We all know that industry is broadly facing challenges as more consumers now opt for those streaming options. But there will be a lot of attention, we know, on Disney's streaming service, Disney Plus, and how many subscribers they picked up in the first quarter. We know in the first quarter, it's usually kind of soft for the streaming industry overall. So Lumley is betting here that if Disney did add subscribers, it will probably be just low single-digit millions, if that. He says that he is more curious, though, about what the profitability and margins can look like long term for the streaming division. Now remember, there's also Disney's sports segment that includes ESPN. There's a new ESPN standalone streaming service we know that's set to debut in 2025. Investors, though, still have plenty of questions about that service. What features and content are going to set it apart from the competition? And of course, importantly, what is the price going to be? Finally, there's Disney's experience segment. Now that includes the company's theme parks. This has been the most consistent division for Disney, showing strong growth, especially on the international side. Investors are curious about whether Disney can keep that momentum going. Disney did say it plans to spend $60 billion to expand its theme parks and cruise lines over the next 10 years. Lumley says he is still looking, though, for more information and details about how and where exactly that money is going to get deployed. Bottom line, Disney CEO Bob Iger should be coming into this earnings report feeling pretty positive. His stock, it's moving in the right direction, and he recently defeated activist investor Nelson Peltz in that bruising high-profile proxy fight. An ongoing question, however, is who is going to take over from Iger one day? What is the succession plan like at Disney? Investors don't know, and Doug Kreutz, an analyst at TD Cowen, says there actually is no easy answer. Kreutz tells Yahoo Finance that Iger is a proven, tested leader, but he has not developed a deep internal bench of possible candidates. At the same time, Disney has a unique, strong culture, so bringing in somebody from the outside, Kreutz says, could be risky. Brad, back to you.
All right, thanks so much. Great setup here for what we're expecting from the House of Mouse. Josh, appreciate it.
You got it.
And we're also gearing up for a busy week here on Yahoo Finance, including some special content that you don't want to miss. It's Small Business Week here at Yahoo Finance broadly. Small businesses, big opportunities. We're diving into the key themes, challenges, and advice for business owners every single day starting today, May 6th through Friday, May 10th. Plus, here on Wealth, we're doing a deeper dive of our own Health is Wealth. We'll get the top savings, smart spending, and health investment tips from industry experts and wellness executives across telehealth, pharmacy, and physical fitness. You can see an all-star lineup for the week, kicking off today at 11:20 a.m. Eastern Time. Coming up, everyone, Warren Buffett, Buffy, the stock market slayer, answered shareholder questions this past weekend at Berkshire Hathaway's annual meeting. What it can mean for you and your portfolio next. Let's do a quick check of the market, sponsored by Tasty Trade. There you're taking a look at the major averages at the Yahoo Finance Jumbotron in studio here. The Dow Jones Industrial Average, you're seeing that higher by about 0.2%. The S&P 500 up by about 0.5%, and the Nasdaq Composite up by about 0.6%. This market check has been sponsored by Tasty Trade. They call it Woodstock for capitalists. On Saturday, Warren Buffett answered questions in front of thousands of investors at the annual Berkshire Hathaway shareholders meeting in Omaha, Nebraska. And to tell us all about the meeting, as well as some key takeaways for you as an investor, we've got Kathy Seifert, who is the CFRA Vice President of Equity Research. Kathy, great to grab some time with you here. First and foremost, I mean, we heard Warren Buffett talk about everything from artificial intelligence to Apple to Paramount and much more here. I wonder what jumped out to you from his investing methodology that investors have come to expect over the years that really stood out at this particular year's event.
Well, I think, when we look at what transpired on Saturday, I think the one thing that stood out, given that succession is an issue, is that he really, he was point on, he was spot on, he was very articulate. I think there was one time when he was a little meandering, but, I think that the dynamic and the chemistry between Warren and Greg Abel was a significant component of this meeting. As it relates to his investment strategy, I think investors can take away, sort of two key tenets. Diversification and, time is on your side. He is not an active trader. He is definitely a buy and hold sort of an investor. I think people might have been a little surprised at the large slug of Apple stock that Berkshire sold. I think that's an appropriate rebalancing given how well the stock had done for the company. I mean, it hasn't done that, that great this year, but historically for Berkshire, it's done well. So, in some respects, it was more of the same, which is comforting when your chairman is 93 years old.
Do you expect investors to also then kind of heed or listen into what Warren Buffett was saying about building up a solid cash position for right now in order to have that dry powder to be able to deploy later on? And if that is the thinking that many investors come out of this with, where might be some of the areas that Warren Buffett is looking at that they might look at as well?
Well, if you look at Berkshire in its entirety, there's the operating businesses that tend to be, it's an insurance-based conglomerate with exposure in energy, utilities, rails, and a number of consumer areas. And then their equity position tends to be barbelled between financials and technology. So it's an interesting combination of, it's a very diversified mix between what they have equity positions in and what they have as an operating basis. Now, the average consumer, the average investor, can't necessarily replicate that. You can with a broad-based, an ETF that tracks the S&P 500. And honestly, if you were to talk to, the late Charlie Munger and Warren, they would probably tell that of the average investor or, invest in Berkshire as a proxy for all of those businesses. I think it's interesting, though, that when you talk about their cash hoard, the cash keeps accumulating. Profitability is decent. They've got really attractive yields in their investment income that's throwing off a fair amount of cash. And I get the sense, and I've gotten this for a while, that there is a little bit of frustration about their inability to target and close on a significant deal. And so they've kind of tamped down investors' expectations for what their deal-making activities are going to be. I mean, it still remains a favorite topic of conversation among investors, but that cash hoard, my sense is at some point there may be pressure on them by investors, maybe after Warren is gone, to pay a dividend and do something with that cash.
Coming off of this meeting, I mean, you mentioned the chemistry that the investors were seeing on stage. and really thinking about what the succession plan could look like. Does it feel like there's confidence at this juncture in that succession plan and what the decision making would look like for Berkshire Hathaway, even after Warren Buffett steps away?
Well, I think there was one interesting revelation that came out of the meeting, and that was a sort of offhanded comment that Buffett made about capital allocation. And I think the conventional wisdom was that the investment team would have a hand in some of the capital allocation. But Buffett said that his preference would be to sort of consolidate all that power around Greg Abel. And that's kind of it was a significant point that he made, given that the way Berkshire has communicated their succession planning, they had a plan in place. They weren't really articulating it to the investment community. The fact that Greg Abel was the heir apparent sort of came out a couple years ago in almost like an offhanded comment by Charlie Munger. So this was another kind of offhanded comment that actually had a lot of weight to it, because Greg Abel would consolidate a lot of power. Whether or not he chooses to keep all that power is something, but it would, under the plan that we're led to believe is in place now, he would accrue a lot of the same powers that Warren Buffett currently has.
Yeah, then we'd have to figure out, okay, what is the moniker for Greg Abel at that juncture? I mean, Oracle of Omaha is taken, so we got to figure out something for him in that future.
Yes.
Kathy Seifert, who is the CFRA Vice President of Equity Research. Kathy, great to have you on here with us today. Appreciate it.
Thanks.
Well, it's been complicated times for the healthcare space. Companies, including Walmart and Walgreens, they're pulling back on their clinics. Telehealth leaders, Amwell and Teladoc, seeing shares plummet more than 50% in the past year. Companies like United Health also taking a step back from direct-to-patient services to reassess the profitability equation amid industry challenges. So, what's behind the struggle here? That's the big question. And here with more on the next step in modern healthcare is Included Health CEO Owen Tripp, along with Yahoo Finance's own Anjali Khemlani. Owen, thanks so much for taking the time here with us today. I guess the huge question is something that you've talked about before, and we've already seen telehealth 1.0. A lot of people wondering, all right, what's 1.5 or 1.5 or even 2.0 look like?
Well, Brad, I think we're already well on our way to 2.0. And the good news is it's borne by patient demand and patient experience expectations. See, the problem with telehealth 1.0 is it's just to put a quarter in the jukebox, listen to one song, and then it's over. You don't see the same doctor again. You don't have continuity of care. It doesn't connect with the rest of your experiences. And yet, members and patients have actually really loved that experience. So in telehealth 2.0, it's an integrated experience. It connects all of your healthcare life, not just your clinical and medical life, like your specialty or primary care visits, but your financial wellness too. And that's really the expectation. So this is a real growing up moment for the industry.
Owen, good to talk to you again. I know that one of the points that you've been harping on is also the fact that there's so much more interconnectivity, right? We've got all the wearables that are coming out. Tech companies are really in this space. But at the same time, with the pullbacks that we've seen, the idea being highlighted is that healthcare companies are really the only ones that can focus on healthcare. Retail health hasn't really done a good job. Technology, tech companies have been working for years to try and get their footing in the health space, and we haven't really seen that come to fruition. How is that affecting patients as the traditional health systems kind of falter?
Well, Anjali, you and I both know that this is an incredibly hard industry, and it's attractive for new entrants because it's so large, it's an everyday expectation. But to meet the expectation of patients and members, you do have to have that integrated care. Your primary care, your behavioral health, your specialty, these things all need to be connected in a way that you experience, that feels personalized, that feels like you're treated like an individual member. It's actually really hard to achieve. And to do it at national scale in 50 states, 24/7, that's a new expectation coming out of the pandemic. Very few players are able to meet it. And in order to meet it, you really have to be committed and knowledgeable to healthcare itself. And unfortunately, I just don't think everybody who has stepped into this has that expectation. Looking forward, I'm optimistic that as we raise the bar and expectation around that not only are we going to deliver better outcomes, we're going to build some phenomenal businesses too.
What type of delta in costs should patients be expecting, especially with more of the connectivity between devices and the information that is going to be able to be leveraged in order to give someone a plan that is more specific and customized to them?
I'm so glad you asked that, because we need to get control of costs in this country. It's our single biggest source of personal bankruptcy. It is causing distress for corporations, including the ones you've already featured on the program this morning. And so we need to look forward to not only a healthcare environment that's higher quality, but one that's more affordable too. The great news about virtual care, and connected virtual care in particular, is that you lower the costs of an experience because you don't have those fixed costs of clinics, of buildings, of extra staff. You can deliver a personalized experience wherever the member wants it, whenever the member wants it, at a fraction of the cost. I'm really optimistic that this is going to re-level the playing field for the costs of American healthcare.
And finally, when we're looking at how, individuals are looking to interact with this healthcare system now, right? They're thinking about where their insurance plays a part, how much is cash pay. That has been part of the equation as well when some of these companies have faltered in the recent past. So what is the ideal solution for that? How can you get the payment part of it to match what the consumer demand is?
Well, I think the good news again here is that people are used to very flat and simple pricing for their telehealth visits. That's been a positive. We know the data where telehealth and virtual care are available. Patients prefer it. They rate it very highly. They consistently rate it from an experience perspective over the in-person alternative. Now, the answer, I think, is to make sure that insurance networks that offer this sort of care are offering really clear, easy to follow pricing, no matter where you are and who you are. The good news is we see effort from the largest payers, the largest insurers to do that. We hope the largest health systems will follow, and certainly companies like mine are going to continue to lead the way in transparency and making sure that we put the member first.
And just lastly, while we have you here, Owen, we're trying to figure out what effect inflation is continuing to show within the broader healthcare landscape, and ultimately when people should expect some of the costs within the services that they're paying for to start to recede a little bit.
Yeah, this is concerning me because healthcare has actually been an inflation story for far longer than CPI and many of the producer price indexes and other things that this show follows so well. And the only way that we're going to tamp down healthcare inflation is to drive down the cost of the actual experience and make sure that we're doing the appropriate visits. We're not reproducing unnecessary testing. We're not taking pharmacy that doesn't work, that we're personalizing care to the patient, getting them what they need. So frankly, they get on with their lives in a better, more financially stable and medically stable way. That's the only way that we tamp down inflation. But again, I'm optimistic because the outcomes from programs like these look really spectacular. And as we scale nationally, we should be in good shape.
All right. Deduping some of the testing that is taking place, certainly something that a lot of patients have become privy to asking, do I need that test to be done, or what's the benefit of having that test done as well here? So that is a tip that's come up here before on Wealth. Included Health CEO Owen Tripp and Yahoo Finance's Angelique Milani. Thanks so much for taking the time here today. Coming up here at Yahoo Finance, we're kicking off Small Business Big Opportunities Week. We're diving into the biggest headwinds for small businesses. That's right after the break. Stay tuned. It's Yahoo Finance's Small Businesses Big Opportunities Week. We're taking a look at the landscape of the sector, the challenges and the regulatory amid macro issues that impact them and you. There are more than 33 million small businesses in the U.S., making up 99.9% of all U.S. businesses, according to the U.S. Small Business Administration. You won't want to miss a single day of Small Business Week, so stick with us here. And kicking it off, we're taking a look at macro headwinds facing small businesses today. As a part of Yahoo Finance's Small Businesses Big Opportunities Week, Yahoo Finance's very own Brooke DePalma is here to break it down for us. Hey, Brooke.
Yeah, good morning, Brad. Well, small businesses starting off 2024 with a solid momentum and a solid start here, but there are still key challenges up against the mom and pop businesses. First, finding employees to fill open roles. This comes as 40% of small business owners could not fill open positions in April. And wage inflation, well, that continues to grow too, up between 4 and 6%. Now, two other challenges include inflation and high interest rates. Inflation is high, up 3.5% last month, and that means that anything small businesses need is a bit more expensive here. So think food, think clothing, anything is more expensive for a small business owner to get. And sometimes they need or they have to pass off that cost to consumers. And that is only growing. We spoke to Goldman Sachs' Asai Pompey last week. Here's what she had to say.
Small business owners are feeling the bite of inflation. 71% of them say that inflationary pressures have actually increased in the last 3 months. And as we double-clicked on the drivers of that increase, we see the cost of rent has gone up, the cost of labor has gone up, the cost of goods and services have gone up. And I think, Brad, one important thing to underscore is at that intersection of inflation and small business is that small businesses feel the impact of inflation first, and they are relieved of it last.
Now, it's important to be clear here that even with all these challenges that are facing small businesses, a majority of small businesses do expect revenue growth this year, according to Bank of America's survey. And we'll be following to see if this pulse really changes. Of course, so many headwinds that are hitting small businesses right now are also hitting the state of consumers, which can in turn then affect not only small business, but companies at large.
All right, Brooke, great kickoff to Small Business Week. Thanks so much for taking the time here. Turning now to tax season, the IRS has issued about 91.4 million tax refunds as of the week ending April 26th. That is 0.5% less than the number refunded at the same time last year. And if you're one of the people still waiting on your money, we can help tell you when you're going to get it. Here with more, we've got Yahoo Finance contributor and Maconomics founder, Ross Mack. Ross, how can people see when they should expect to get their refund?
Brad, thanks for having me. So here's the reality, right? The IRS issues roughly 90% of all their refunds within the first 3 weeks, right? Or less. However, in the event that there is maybe a delay, the good thing is on the IRS website, you have the ability to now check your status. So literally on the site, irs.gov/where's-my-refund. Where's my refund? It gives you the ability to just put in your social, your marital statuses, as well as how much you're supposed to get on your refund. And that alone will be able to show you what your status is.
All right. So, Ross, once you have the refund, what should you do with it?
I love the question, right? I think it's very important that everyone needs to be very thoughtful with their money, right? Obviously understanding that, hey, this isn't just a magical bonus that the government was giving you. They're actually just returning the money that you overpaid them the prior year. So knowing that this is your money, most people are probably inclined, oh, let me go on a vacation or let me buy XYZ, big purchase, right? A new purse or, a new car or something. I think being thoughtful. So very first thing I want you to do, and I'm gonna list them in order, right? First thing, I want you to pay off any debt that you have, right? And what I mean by debt, we're talking about that bad debt, that credit card debt, that high interest bearing debt. Next, I want you to have a fully funded emergency fund, right? The average American doesn't have $1,000 saved, right? Meaning they don't have a fully funded emergency fund. I want you to do that. And then step 3, then I want you to start investing, right? Where the very first investment, if you're not investing, I want you to own a very diversified portfolio coming in the realm of a S&P 500 ETF. And then lastly and fourth, in the event you have to go shopping, right? Now you can make your big purchase. But you want to make sure you don't have any bad debt. You want to make sure you have that fully funded emergency fund and making sure that you're investing, right? The goal is to allow your money to make more money for you.
All right. I would have spent it on Warren Buffett's Squishmallows, but I hear they're all gone and sold out from the weekend here. Thanks so much. Appreciate it, Ross.
My man, thank you.
Absolutely. We've got much more on wealth after the break. You're watching Yahoo Finance. Well, we're deep into spring, heading into summer, and the wedding season is right around the corner. We're talking money and relationships here on Wealth. 50% of U.S. adults said that they at least somewhat supported the use of prenuptial agreements, but only 1 in 5 married couples have prenups, according to Axios. Money is a controversial topic in many relationships, but it doesn't have to be. And to break down the conversations that you should be having at every stage of a relationship is Sandy Bragar, who is the experienced Chief Client Officer here with us. Sandy, thanks so much for taking the time. I mean, I imagine a lot of people are going to be taking notes here, myself included, because all of us can learn a little bit more about how to discuss finances in relationships. First and foremost, I mean, I don't want to start with the hard-pressing topic of prenups and when they should be discussed, but when should couples start discussing their finances and being able to really plan for the future together as well?
Brad, we think that it's never too soon to start talking about money.
All right, date number 1, that's it.
It works for some people. Money can be a challenging topic for people. We all come at it from different experiences. We have different mindsets about it, where we've heard different scripts about it when we were children. So being able to open up that conversation with the person you love early on and learn how to have those money relationship conversations can really help things along.
All right, now we'll get into the nitty-gritty. When should people start discussing prenups and evaluating whether or not that they are right for their relationship?
So I think premarital agreements are really helpful tools for couples. We talk about them with our clients all the time. We work with corporate executives, family business owners, entrepreneurs, inheritors. So they come up all the time as people are going through life. And premarital agreements can be helpful because they sort of encourage that money conversation early on. And it causes the couple to think about things, not so much on what happens if the marriage doesn't break up or doesn't work out, which is what people think a lot is the purpose of a premarital agreement. But really, it helps inform the couple about what the state rules are around marriage in the state where they reside. It helps them learn what's most important to them and how to arrange their responsibilities and expectations within the marriage. And that's really important, in addition to figuring out, well, geez, if the marriage doesn't happen, what are the expectations we should set for each other and how will things work out? So that everyone, both people are coming into the marriage really knowing what's most important to them and how things will work out. They don't have to guess and they just have some comfort and confidence.
Yeah, that's great wisdom on the thought process, and it sounds like you're actively discussing that with your clients. Something that you're also discussing with your clients is giving the gift of financial stability. I mean, walk us through that and what that actually looks like in practice.
It's becoming quite popular among our clients because they see the importance of having these open money conversations. So oftentimes clients will ask if they can provide a financial plan to a couple, usually a son and daughter or the next generation of their family. Maybe it's a grandchild or a niece or nephew. But those are great ways for the couple to have an experience of going through the planning process. Sometimes they give coaching sessions to couples, and other times there are family wealth dynamic experts who can come in and really help the couple with their communication in thinking through their money identities and what they're bringing to the table, not so much in terms of their wealth, but their perspectives and relationships with money.
Wow, yeah, and that's really important. I mean, because as you were mentioning earlier, it's about the couple and their own experiences, either growing up or even as their own standalone financial abilities have transpired even prior to meeting each other, how that can moderate ebb and flow, and then combining forces there, amazingly important, especially when you're planning as well for children too. What do those conversations sound like?
So they're much the same. What are our values? What's most important to us? What's our vision for our family? If the couple can think through all of those things before they get to the financial aspects of planning a family, that can help things out a lot. I can tell you as a financial planner, if you focus on just the money aspects of raising children, that can be more of birth control rather than trying to plan a family, because there's a lot of expenses involved. But if the couple is on the same page about what they're envisioning, they can sort of chunk out all those financial aspects. First and foremost, how many kids are we going to have? When are we going to have them? How far apart will they be? What does that do to our housing arrangements? Do we need to move? Do we need a new home? What does it mean for our careers and caregiving? Is one of us going to stay home? Is one of us, or are both of us going to work and we need to hire in some help? Or is there family to help support this child or children as they're being raised? So there's all sorts of money conversations that come up as one is, or as a couple is raising their family, and just being nimble and having those ground skills for having effective money conversations along the way can be really helpful.
You mentioned that housing planning as well here too, and there are a lot of couples whose home ownership goals may be in limbo as of right now, especially given the mortgage rate environment, and just trying to figure out, okay, when can we adequately plan? How can we adequately plan and save towards what is a moving figure at this juncture? How are you hearing some of your own conversations and clients kind of navigate that planning?
Well, it all depends upon the couple, what's most important to them, right, what their own financial factors are, and sort of what their time horizon is. But we've definitely seen some clients who've chosen to rent for a little while, try out a new neighborhood, make sure that they like it before really diving in and committing to the home there. But certainly interest rates are high right now. They might not always be. So with mortgages, there is opportunity to refinance. So it's just a matter of making sure that they can afford what they're looking to afford right now.
It's a great reminder as well. Sandy Bregar, who is the Aspirient Chief Client Officer. Thanks so much for taking the time in studio with us.
Thank you, Brad.
Appreciate it. We've got much more on wealth after the break. You're watching Yahoo Finance.
Welcome back to Yahoo Finance's coverage of the Milken Conference at the Beverly Hills Hilton here in California. Special guest with us right now, IMF Managing Director Kristalina Georgieva. Manager Director, good to see you again. Congrats on the new 5-year term.
Thank you very much.
Really enjoyed the panel. You just got off moments ago, and you talked a little bit, and you have been talking about this, the tepid 20s. For the average investor out there, or the average economist, what do you mean by that, and what should you expect in terms of growth in the tepid 20s?
What we have today is a world economy that has proven to be remarkably resilient. Just a year ago, we feared recession. That didn't happen. But we also have a historically slow growth projected over the next years. So if we don't take action to generate more impetus for growth, we are going to end up with a decade that is disappointing. Just to give you the perspective, before the pandemic, on average, the world would grow 3.8%. Now we project just slightly over 3%. And at the same time, the population on the planet has increased. The aspirations of people for better lives are there. They are not going to be met with such a disappointing growth. And this is why at the IMF, we strongly recommend to turn attention to more growth-oriented fiscal policy, monetary policy, and of course, recognizing that what would make the biggest difference is human capital and the foundation for a digital transformation, for a green transformation.
Can the U.S., let's focus on the U.S., can the U.S. take those fiscal actions given the high levels of debt the country has?
But the U.S. Is in a very privileged position right now. It is because of high interest rates, strong dollar, and very strong economy, very attractive for financial flows. In fact, 1/3 of the money that moves around in this world comes to the United States. It was only 18% before the pandemic. Now, if in this condition, the US is still shy to take action to reduce debt when the economy is strong and when financial flows come this way, then when would it do it? And we believe that when we did a very careful analysis of the revenues of the United States and the spending in the United States, we identified plenty of steps that can be taken that are not affecting growth prospects. There are tax exemptions that are not growth enhancing that can be eliminated. And also on the spending side, the US is still spending as if it has youthful population that it had some decades ago. That has to be corrected.
I'm still pretty young.
Well, you are, but the US as a whole, unfortunately, is aging. I mean, it is being helped by being still the most attractive place to live, so many young people are coming to the United States. But overall, fiscal policy in the United States really needs to take care of this, because with interest rates so high, the burden of servicing debt is exceptionally high. Today, the federal government spends over 17% of its revenues just to service debt. In 2015, when interest rates were at their lowest, they were spending less than 7%. That's a very massive increase, and it begs for action.
I need to get in your mind for a second, because we have former President Trump, who's floated 60% tariffs on Chinese goods. When you hear that, how bad would that be for U.S. growth?
Look, I mean, who is the president of the United States is the choice of the American people. And we are never commenting on policies that are not being announced. So we need to see what is the choice of the American people, and then what policies are being put in practice that are in place. But what we need to remember in this context is that the reason the American people and people around the world have turned against globalization is very serious. It is that for quite some time we all would claim that because globalization lifts up incomes on average, it is good for everyone. No, it wasn't. We had communities that suffered the negative impacts of their jobs being wiped out without sufficient attention. And I actually think that for the future, it is, of course, the issue of how one manages trade and investments. We are in favor of a more integrated economy because it leads to better allocation of capital and higher incomes for everybody. But to do so, being mindful that if in society there is sense of unfairness of the economic story, then people will be on the street, and then we would see more push back on what has worked for us. I mean, just look at the last 30 years. The tremendous benefit for everybody from an integrated global economy. It would be really a tragedy if we are to lose it.
One of the things that U.S. consumers continue to have a problem dealing with is inflation. Now, we heard Chair Jerome Powell say last week he doesn't see stagflation. He sees inflation coming back down. Do you see stagflation? Why is inflation still high?
Well, the reason inflation is going sidewalk, not going down as it has been for some time, is it comes from the strength of the U.S. economy. The consumer is still pushing for goods, and that strength turns into a problem for Chair Powell. By the way, this is why it is important on the fiscal side to be more prudent so the fiscal doesn't inject more risk of inflation staying here for longer. Let's remember that Chair Powell holds a lot of the capacity to cool inflation, but not all. What we see in the United States, very important factor is the repair of supply chains and the ability to meet this demand that is still quite strong. In our baseline, we expect to see inflation going down to target this year, and we expect to see the Fed starting to cut. But
Two cuts this year.
To cut this year, but you know, it would depend on developments in the United States, and unfortunately, it also depends on developments outside of the United States. If we have geopolitics to push energy prices up, that would be very problematic for Chair Powell, but it would be problematic for everybody around the world.
Thank you for doing this. It was so nice to see you again. I know you're a very in-demand person here. We'll let you get back to the action. IMF Managing Director Kristalina Georgieva, good to see you again. We appreciate it.
Great to see you. Thank you.
Brad, back to you.
All right, thanks so much. Excellent interview there. Our own executive editor, Brian Sozzi. Let's do a quick check of the markets as of right now. The Dow, the S&P 500, and the Nasdaq holding on to gains. I'm Brad Smith. That does it for us here today on Wealth on Yahoo Finance. We'll see you tomorrow at 11 a.m.